Trade Roundup, everybody. ICT mentorship follow through. It's your boy Kit. We're hanging out. Michael just finished up. You know the deal. You know the routine. It's feedback time. I need to know what you heard, right? All we are is a feedback loop. I'm not going to talk anymore. I want to hear from you. Abigail, Caps, Trader, Double A Trades, Hunting Ticks. If you didn't get an opportunity to speak, now's a great time to grab the mic. Okay. Folks coming up, we got feedback on the ICT mentorship. Alex, you're going to go up first. How's it going, buddy? Yes, sir. You know what the deal is, correct?
Yeah, absolutely. Fairly new to it. I've been trying to learn trading for about 2 years ish. Take the first year and toss it in the trash. I was bullshitting all the time, not putting my all into it. The last 3 or 4 months is when I've really been bunkering down, trying to learn everything and grasp all the concepts. This session today was extremely eye opening. It, I can't. Go ahead, I'm listening.
Yeah, no, pretty pleased. I love feedback, brother. We love it. That's why we're here.
Yeah, just not it helped me be more secure with not being so impulsive. That was my main problem. It's like, oh, I'm gonna miss the move, and just seeing how Michael explained everything and broke everything down. Pairing that with that first presented fair value gap today, golden, just easy. And it kind of pisses me off that I wasted so much time and not applying myself. That it's really that simple. Once you apply yourself and just listen to his teachings and what he's saying to do. Yeah, man, I'm just lost for words. I appreciate everything y'all do for the community, man, and I just hope that they don't try to take the stuff away from us, man. Because Jesus.
No. Don't stress about things being taken away. Let's go over today what happened and what was laid out with the RTH gap. What happened pre-market? What was being talked about? What was looked at? What your eye was being brought to where price went and where and how the logic was presented. We're all witness to this ICT mentorship, and feedback is important. Okay, so I need to hear from you, your thoughts, 2 cents. Alex, I love it. Abigail, I'd love to hear from you. Echo, Caps, Nico Suarez coming up. I love the name, Nico Suarez. It's like Rico Suave. I got my boy David up here, FX for Living, co-hosting with me. Right? Do me a favor if you're here, give this a share. Share this on your page. We are trying to be a follow through. We are a voice. You get an opportunity to come up here. You literally just heard the lecture. And now what is your response? That is the idea, to be the feedback loop. That's all we are, is a conduit. David and I we're meant to be quiet, and you in your voice, and the more people that we can have come up here and provide thoughtful feedback on what you heard, what you're learning, and the efficacy of the message that's been brought to you. That's the idea. That's why we're here. So what did you learn is, again, the question that we're asking. Market Oracle, you've done a good job. I like hearing your thoughts and feedback. My brother, if you don't mind, what did you learn today?
Yeah, Kate, how you doing, man?
I'm doing fantastic. I love the kind of vibe that we're getting in here doing this. We've gone from daily highs. We filled the RTH gap. We've filled the NWOG here from February 8th. The question is, are we going to continue retracing back into previous ranges? If we leave this NWOG, I can tell you 24,756 falls onto the cards for me, where before I was really looking for the monthly open, going from the weekly open to the monthly open. But curiously, if the NWOG does not hold, it's interesting how the NWOG works as kind of like a range, kind of like limiter, as it's been explained, gap theory by ICT mentorship, being included this year in the RTH gap being highlighted. And no, that does not stand for real time, right? It stands for regular trading hours. Okay. Market Oracle, do you have more to provide? If folks, Hawkeye's coming up, I like it. Nico's here. Norel,
Man, I finally see everything. This is an eye-opening session for me.
It's very
Not just
nice.
this one, but over the past few weeks. Even today, I can see market make a sell model, 10 a.m. silver bullet, 10 a.m. for
February
secondary fair value gap.
February 6th RTH gap, I believe, could be the draw. That's a really big trade. That's falling back into, was it Friday? But the overnight session coming out of Thursday into the Friday session. And for me, there's still some inefficiencies there, which, are always interesting to see, because they work very well as a draw, on liquidity. So as we leave these ranges, for me, these weekly gaps as described by ICT really work as a form of kind of a range limiter. So you're either going to see price, get sucked up back from that MWOG, or it's going to fall out of. And the interesting thing is what price will do. So keeping the conversation going, keeping it flowing. My boy David, FX for a living, what were your thoughts and 2 cents on what you just watched, what you just witnessed from Michael on the YouTube channel? David, mon ami. We'll get back to David. We'll add some more folks. Hawkeye, you're up next, buddy. Hawkeye, can you hear me? Can you hear me, guys?
Oh, we're both on. Okay, let me let you speak, bro.
All right. Yeah, I can hear. I mean, I
Yeah.
hope you guys can hear me. I don't know, man. I mean, X is like constantly rugging us, so it's like I'm holding my breath like, oh shit.
So I was on mute, but so yeah, I see him trading these range gaps, but it's like, okay, he's got the one on from last Wednesday, February 4th. Like, how come he's picking that gap specifically? Is it just because
Well, that's a good question. What are the specific or unique characteristics of that gap pre-open today that you can derive or ascertain from?
Well, I was seeing we were hanging out at like the top of it, basically. That's what I was seeing. And then it looked like we had a turtle soup, and then we ran to mid gap, and then we kept going. But
yeah, I mean, Wednesday seems relevant because that's where the prices were, like at 9:30 on Wednesday, very similar to where he was referencing, right? It just happened to be on Wednesday. Is there a reason why it was Wednesday? Well, because that was a similar price range, right? Similar price.
So that's just the range that we're in. That's why we're looking at that specific gap, because that's where we're at.
Yes, and being mindful and keeping an eye to constantly be looking to your left, I believe further helps traders really understand what they're looking at and where they're going to go later as well.
Yeah, I was freaking out this morning because my chart on NQ on TradingView was like delayed. It was like 15 minutes delayed or something. Like when it was 9:50 something, it was saying I was at 9:47, and I had to watch what he was doing on the regular NASDAQ chart and not the NQ chart because my NQ chart was delayed. I'm just wondering if anybody else had that issue, if it was just something happening with me.
I mean, data can be interesting, right? Depending on your data feed, depending on where you get it. Sometimes you can get gaps in data. You can get actual like candles and minutes that are missing. I mean, I've live streamed and there's been times where that's happened to me. Ooh, body close outside of the NWOG. That's looking to me like stop goes up. Now, I don't want to say where stop goes, but I would be looking at price continuing out of that NWOG, to and through it towards some previous days, EQ. That previous day, I think, would be Friday. So Friday's, middle of the day, we'd be looking for, we had Friday, Monday, Tuesday, we're in the Wednesday. Wednesday is falling bearishly, leaving a gap, and all we're doing is rebalancing a Friday range. So if I were you, I'd be looking at Friday's high and low and then looking for the EQ of that price and see as we had these days range above it, with the gaps in the monthly open above on NQ, where and how now that the chance or likelihood leaving the NWOG that we actually retrace back into what day's range? Friday's range. Why? Because it's still unmitigated. There are still inefficiencies present. So that's a large range. Go ahead. What?
When you say it's unmitigated, that means it's like not balanced, right? So like there's still...
Correct. Yes, sir. We'd be looking at just returning to a previous day's 50% to rebalance the range. And what equates to a rebalance is when price returns to that 50%.
And there's usually going to be a fair value gap in that area, or
there's going to be, yes, you will find key inefficiencies. And I mean, that's precisely what the PD array matrix is when you start looking for and keying off of mitigation blocks near the 50% from, fair value gaps, liquidity voids, order blocks, where and how they're located within the kind of the Fibonacci levels of, premium and discount. Right.
Well, cool. I found you guys, and this is really good to have to be able to talk about his lessons afterwards. I'm loving this.
Oh yeah. That's the idea. That's what we're really, really trying to do, is just kind of pick up and then he comes back and listens, and you, the community, can provide feedback on the lessons, which is what he's looking for. So we're trying to create a feedback loop, both for the community as well as the mentor, that then becomes a conduit towards, being a classroom of price, being a way in which we come together. We've been doing it now. This is going on the 4th year. I've known Michael now for 3 years, coming up 3 years. We're in month 34. Since Michael met me, I've known him for well over a decade, but he just met, me 3 years ago almost. And we've been doing this pretty strong, on social media, and it's been a very cool convergence. It feels like it's coming together strongly, and the idea is to learn faster because the sense of urgency is real. So sense of urgency is real.
Yeah, it's cool. Cause I don't have like anybody that knows the stuff that I'm learning. I can't talk with my family about it. I can try, but that's a different language. And so it's like cool to be able to get on here and actually just to be able to listen to people talking about it is like helping me out so much. So
yeah, dude, that's awesome. I love that. Again, when Michael comes on and there's just been some really, really, really good content, of late, and just all around of just the community engagement, of everybody, him with us and then us with him. It's just really good. Very good. Just.
What do you guys think about the whole, like, people saying shit like, oh, well, ICT's the new retail or whatever?
It's just coming from folks who don't understand, what he is or what he does, or, the methodology, I believe. Right. People can say that. He's reached such a name for himself, and then his ability to, kind of read the breath of a candle, and do it live and things like today, and be like, hey, I'm showing you where I would like to outline and watch the market go. And then it just goes right there. And you're like, oh, wow. That's pretty impressive.
With me, it was like, it took a lot for me to even decide to get into his content and decide to, okay, I'm actually going to consume this and see what I learn from it.
Well, I think a lot of people kind of fall in that realm. A lot of folks are going to be kind of coming across him, and they have to discern and determine for themselves, is this something that I want to invest time and energy in? Right. And I can say, as, a 48-year-old man, as someone who's been studying this man's concepts for over a decade, someone who's made quite a bit of money in the market, and in full disclosure, someone who's lost money in the market, quite a bit of money, right? And in full disclosure, someone who's been divorced twice because of, the shenanigans in which I, have done what I've done in the past within the market. So my relationship intertwined with the market, good and bad, has really defined who and what I am. And then my relationship with Michael and Michael's content also has really helped shape and define who and what I am. And, here we are, just trying to be a good person, trying to be a good trader, and trying to help people do the same thing,
Good stuff,
on the
man.
journey.
I love it.
So price coming back up, refusing to leave that NWOG. Is it going to flip from here? You're going to get the turtle soup with the flip right back into the range, coming for the highs. We only took one low. We're at the weekly open. Or are we going to continue down and rebalance this Friday range? For me, the NWOG will indeed tell the story. It acts as a range limiter, and, ICT's gap theory Mentorship 23, 24, he talks a lot about the new week opening gap, the new day opening gap. Folks ask about the B adjust. When you look at the quarterly contracts and the quarterly rollover, you would naturally not incur or utilize the B adjust, and you would naturally utilize the continuous contract so that you could utilize then the same gap theory on the quarterly gaps. And then you would have those visible and you'd be utilizing those gaps similar within a quarter as then you utilize within the week and the day as taught by Michael himself. So anyway, I just wanted to address that quickly. Some folks ask about B adjust. Why you leave B adjust off is because you want to be able to see that gap. There he is, man himself. Nice to see. Hawkeye, very nice comments. Justin, your thoughts, take feedback on the mentorship.
Yeah, man. I don't know, but today was really a great session. It was actually my first time seeing the gap concept being broken down like that, man. And dog, it makes sense. The way he tied it up into liquidity and executions, man, it really helped me a lot. I was like, what is going on? I was just in the zone, but I don't have the words for it, but you get me right. You get me right.
Oh, I totally get what you're saying. And I mean, when he makes it look easy and he says he draws your eye here and then there's a logic and a rationale and a reason for why. And then prices just kind of do what it does. And you see kind of the entry of volatility, the way he's talking about the actual mechanics of the market. And my belief personally is what was probably one of the most valuable things today, understanding market mechanics, the concepts, the verbiage, the utility of order pairing. And just a lot of, if you were to go back and listen, maybe to the person not as familiar with the vocabulary and verbiage utilized, in describing market maker models and, again, order pairing or market mechanics, and where and how specific, buyers and sellers and participants are able to, as he said, shake hands. Right. I thought he was explaining it very, very well, but you're really looking at some complex market mechanics. These are mechanics, things that are happening all of the time. These order pairing that's happening all of the time. And you, the trader who's able to actually conceptualize this and the way Michael was explaining it and the way it played out real time. It almost looks easy, right?
Yeah, man. Thank you all for all this you're doing, people. I'm so happy, and I'm happy. Literally, I have no words to explain how I feel. It's my first time speaking here.
Good.
It's my
It's a
first
good
year
day to be smiling ear to
focusing
ear,
on
right?
the
It's a good day to
app.
be smiling ear to ear. I'm happy to hear that,
Yeah,
buddy. I'm happy to hear that for you.
but
So anyway,
I'm happy,
we've got
man.
we got body closure now on the CE on the opposite side of that NWOG. So I'd be mindful of that. We're in that NWOG now. I'd be insecure
Yeah,
exactly of the direction. I still like the south side, but we're sucked back up and up into that range. And I'd like to really see it that NWOG act as a limiter right now. We're back to the weekly open, but
What is the NLOG? I've never.
yeah. I also want
pardon?
to keep my eye right on that thing too.
Pardon, sir? What
I also want to keep my eye right on that.
was the question?
Now I was just adding up that I also want to keep my eye on the gap too, bro.
Oh yeah, the February 8th and the new week opening gap and the weekly open. We're right there on NASDAQ right now. So be very interesting to see
Yeah.
if we
Anyways, thank
retrace
you
back
for
into
the
Friday's
opportunity.
range to rebalance, or if we were to somehow impulse back within that range.
What is this NLOG
Let's
that
keep the conversation going. Let's keep the conversation going, guys. We can talk about the market all day. I want to hear about your thoughts and feedback. We want to hear, what did you learn? What did you learn? That's the theme of Trader Roundup ICT Mentorship Follow Through. We could talk the market all day, but I mean, feedback. David, FX for Living, are you there, mate? We'll come back to David. Norel.
Yeah, I'm here.
All
I'm
right.
here.
Thoughts and feedback, buddy.
Yeah.
And if you're not
One,
speaking, pretty please put your speaker tag on mute, and then you will unmute it when you come in and engage within the conversation. Thank you so much. And awesome, Norel, what are your thoughts, 2 cents on the ICT mentorship today? What did you learn?
First, this is my first time speaking, so thank you, Kit. And Michael, thank you. I see you in here. Um, I didn't catch the whole live stream today, unfortunately, but everything that I did catch when I was in it is just confirmation for me. The biggest things that I'm learning day by day is patience, and it's not about each individual session or getting in on each specific move. It's about the timing, my process about getting to that, and then actually being there to execute and knowing when to get in or get out or, keep my stop and be patient. Or it's just the biggest things for me. It's not price itself. It's not the market. It's me. It's timing. It's patience. Like that is the biggest thing right now. Like it's to the point where I'm in front of the market every New York session, every day at work. And even if I can't trade, I'm like, okay, I think it's going to be like this. I see it like that. And then I come back to it and it does what it does what I thought it or I wanted it to do. And I didn't get in, but at the same time, it's like, okay, that's still good, positive results for me. Like that's what I need to see. That's what I want to see because for me, it's not about the money. In my eyes, the market is unlimited. The profit potential is unlimited. It's not about the money. One day
Then
we could make,
you are a Padawan. You are learning from the man himself. And I love hearing that because that is 100% you're listening to what he is saying and what he's teaching. So I love hearing that, Narelle. Narelle, I got a lot of folks here and I really want to get some feedback here.
so go ahead.
No, that's cool. I just want to give you the opportunity. Did you have any question or anything that you had potentially? If not, that's cool because you said a lot and I value and appreciate you, buddy. You had a really good session today, and I really want to get other folks' thoughts and 2 cents, but I really want you to, say your piece too,
Yeah, I don't want to take up too much time
All
because
good,
I
brother.
really
High
said
five.
how
Yeah,
I
high five.
feel.
Yeah, you did great. I'm not trying to put you on the spot or nothing, so it's all
No,
good.
no, I'm gonna leave it at this because I'm looking at the 1 minute chart right now,
Ooh,
and
look at us close out of that.
it looks like it's going back up,
I
but
mean,
I don't.
I'm not shocked or surprised. I mean, I know what I want. I know what I would want to see. And, I would be making decisions inside that, NWOG. And as it leaves in one direction or the other, I'm either on side or not. I mean, if you wanted to make decisions to go long from the CE of that MWOG, that's, very ICT like in a model. But if you didn't want to do anything or you're refraining from doing anything until you saw something else within your if then tree, then, that could be it too. Anyway, keeping the conversation going. Again, Hunt Trades has his hand up. A lot of folks excited, and we want to hear from you. So, Hunt Trades,
Hello.
yes, sir. Oh, well.
Okay, I have a few questions. Well, not a few, a couple. First off, did you butt dial me last night, or did
I
you call
think
me and I
no,
couldn't hear you?
I did DM. I do DM call folks. You were on the list of folks that I DM called. So yes, it was not a butt dial. I did mean to call you, but
Okay, so I answered, and I don't think you could hear me, so I
yeah,
was super
maybe I don't know,
bummed.
dude. I don't know, but
Second thing, the patience that Narelle was speaking about is huge. That's my issue too, and I've kind of started trying to make the switch to trading gold because NQ is just. I think I have some scar tissue, as Michael would say, from trading it as I was learning for so long. And now with gold, it moves. It's similar, but it's different. Like all the stuff still works, but it's more steady compared to like jerking around and giving you like a heart attack every time your position goes against you because you think it might drop like all the way to your stop and then keep going in your favor.
NQ?
So
No.
yeah, every once in a while. But today, because I'm used to that, I had my stop like it was in profit. I was in a good trade. And then I'm like trying to hit my stupid consistency target for these prop firms and whatever. And I was like $80 away from it. And then I'm sitting here thinking like, wait, how much am I actively risking right now to make this $80? And then I ended up giving back like $300 of what I was like from my high point of profit. And that's something that I had to, make note of for myself, because you should not be risking $300 to make 80. That's just poor risk management and being kind of a dummy. So
Cognizant. That's
that's some
good. Very good. From the lecture specifically, anything from the delivery of material that Michael provided that you can think of resonated with you, on or off the charts, what you saw, what you learned, any of that?
I have kind of an older question that I have in my notes from a while back. If he can come up
Well,
and answer, maybe you can.
he's here. He has a speaker tag, so maybe I'm still trying to get the question answered, Hunt. So, you have a list that you have, so we can go over that, buddy. I mean, I don't think that's an issue. I am
The
very
first
interested in following through on the lecture series today. But I feel you, brother. Go ahead, bro.
the first one is the short question, and I was listening to his like 6-hour farewell talk from like a couple years back. And my question was just a short one, like what made him come back? I'm curious about that. And then my more technical question is, sometimes you'll notice like a fair value gap will form before a range is finished. So let's talk about like for the morning AM opening range, for example, the first presented fair value gap, it forms, and then as the range expands, that fair value gap, because we talk about fair value gaps that overlap quadrants of wicks and NWOGs and NDOGs and any other like time-based range. So the range hasn't finished because it's say 945, the first presented fair value gap forms. And then after the range finishes, we see that fair value gap is right on the 50% of the AM opening range, or it's on a quadrant of the AM opening range. Is that something, obviously we all know if we're here that that's not random, but is that something that we should put higher weight behind? And is that something that's like works the same way as the quadrants that form after the fair value gaps that form on the quadrants after the range is formed? It was kind of a long question. Does it make sense?
Yeah, I have no clue what you said, so I appreciate it, but I have no fucking clue what you said. So I can't even ask you to repeat it, because here's the thing. When we have very highly technical, specific individual questions, and we came here for what he delivered in regard to highly technical, specific questions, for me, it's really hard to overlay. My mind is on the lecture and what was delivered through ICT and what we just got done talking about. So what you just said, Hunt Trades, I love you, buddy, but you sounded like one of the adults on the Charlie Brown show. Wah, 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 wah.
Good morning.
It wasn't regarding this lecture from today.
No. I got you, brother. I got you. Well, Michael's here. Michael, I don't know if you caught what he said. I was just saying I didn't. So that's it.
Okay.
It's harder.
Can you hear
It's
me?
harder to ask that question when you're not in front of a chart with somebody. But
It's highly technical. Again, Michael's here. Feel free to jump in. Welcome, Michael. Nice to see you.
Doing well. How are you?
Very well. Wonderful calls on the market today. Just want to say that quickly. Beautiful. Well, awesome lecture today. Very, very good. Awesome. Very awesome to witness.
Clean price action is back, and it's so welcome to see it, isn't it? All right. So I heard the first question, that was pertaining to why did I come back? Multiple reasons. Number one, I got inundated by people all around the world sending me emails saying, hey, look, I missed this, opportunity to do it. Would you ever consider coming back and doing it again? And it's just a lot of people put, a lot of guilt on me, and I just feel like I didn't live up to what I promised the Lord I would do. So here I am again. So obviously there's no paid mentorships. There's no ticket ad, no for sale type stuff. But it was just more or less a big, huge community wave of interest that came in, and they more or less talked me into it. The second question, I'm not entirely convinced that I understood what you were saying, but I'll say this. Anytime that you have an actual range where the previous price run has taken place, it doesn't matter what time, okay, just any price run. It's obvious when you look at price, a high and a low.
If you measure that and you put your gradient levels across that, any fair value gap that lays over top of one of those gradient levels, it's going to be a salient fair value gap to use. Then all you have to do is plug and play what your bias and narrative is for that given dealing range. An implied dealing range is something that you think, like for instance, today we talked about how where the market's likely to draw directionally, and then if smart money does accumulate a certain side of the marketplace, for instance, today shorting, where would they actively seek to buy back at a lower price? Well, knowing those levels, even if it was the first level I told you that was the first stage offset distribution for sell side, that in and of itself might be your model, and you're not interested. You're not, inclined to hold for any further than that. Then what you would do is just lay down, your gradient levels over that, and any existing fair value gaps that were running up to make that high after 930's opening. If it's a BISI, then you can go with a great deal of conviction that it's going to act as a inversion fair value gap. So what I think I heard when you were saying at 8 o'clock in the morning, if you start doing something after that time, everything I just said there about those two, I guess, events and utilizing gradient levels and coupling them with fair value gaps is applicable all the time. It just makes it so much more precise when you target times of the day when volatility is elevated. So that means like the session times, pre-session right before 9:30, 9:30 to 10 o'clock, the 1:30 to 2 o'clock in the afternoon, the session beginning opening range for PM session, New York session, and then the last hour trading. So those times of the day when there's a large influx of volatility injected in the marketplace, when you start running your gradient levels on what you think the price is going to run to or an existing price run that's already transpired, any fair value gap that forms in old runs like that, they're going to be utilized. Anything, if you have your analysis correct, if you know what it's reaching for, by anchoring your fib with that, you can anticipate before the candlesticks even get there, you can anticipate them forming in an imbalance there that will become a fair value gap that's useful for trading.
That pretty much answered my question. Thank you very much for that.
Awesome.
That was awesome.
Thank you.
Yeah, of course.
We call that Jordan from the foul line, right, Hunt Trades? That's what we call that.
Nothing but net right there, baby.
He's like, I'll drill that one from the 3-point line. So awesome. Great to hear. So Hunt Trades, you're content. You had your your question answered. Continuing the conversation, we are looking for follow through, your thoughts, your 2 cents on the lecture, the delivery today. Gerald Juan, ICT Park.
Hello?
I'm gonna
Can you
give
hear me?
up my speaker tag so
That's
more
cool,
people
buddy. I
can come up.
appreciate it. You know,
Thank
we
you.
got folks coming up, so it's sought after. That's for sure.
Yes, sir. Thanks, Michael.
Hello? Can you hear me?
Yes, sir, we can.
All right. First and foremost, I am not well versed in English because I live in Germany, but I have a topic that might help many students here. So looking at the lecture today and in terms of ranges, if we grade the highest high up to this point in the day, after the regular trading hour opened down to the pre-market session low at 7 a.m., grading the eighths of that, what I want the people here to think about is each stage of the market maker model being utilized on the left side, for instance today, as reaccumulation, on the right side as a stage of redistribution. And the question regarding today's lecture is, once we, for instance, look at the today 1 minute chart, 8:46 a.m. buy side imbalance, in which the 8:52 a.m. low had formed, so that buy side imbalance has been utilized as support on price prior to the smart money reversal, and has also overlapped with the 0.625 level of the range from current high of day down to the 7 a.m. session low. Once we close above that and are nearing the time of 9:50, can we anticipate the 5-second chart and the 15-second chart to, let's say, enter the sell program in the means of each time when it takes out a swing low on the 15-second? The only reason why it retraces up is to offer smart money a measure of premium and fair value to short. And if we can see the signatures, for instance, during the retracement leg into the last stage of reaccumulation prior to the smart money reversal, then on the right side form the first stage of redistribution with a 5-second buy side imbalance that has traded into that initial redistribution on the right side that aligns with the last reaccumulation on the left side to form the fractal market maker sell model on the 5-second chart, with the origination, which means the smart money reversal on the 5-second chart, being the redistribution or the last stage of redistribution on the left side. So basically what I am saying, coming to the point, is can we expect each reaccumulation stage on the left side on the market maker sell model to become a redistribution stage on the right side by measuring the order flow and what we expect of institutional order flow on the fractal 5-second and 15-second chart? That is my question.
Okay, I'm going to be honest with you. I was trying very, very hard to follow you, and it was a lot going on in there. And the times I thought I understood where you were going, you lost me with all the details. I didn't know if you were making a statement or if you were teaching or if you were asking a question. Like, I didn't know what you were doing.
Yeah.
But I will say this: the last portion of what you were saying, it sounded as if you were asking if, let's say, for instance, you used the example of a market maker sell model. Okay, so the market maker sell model is going to have the buy side of the curve first, and then it sells off and goes back to the risk consolidation. So the sell side of the curve is the second part of it. The first part is the buy side. So your question is, if I'm correct, everything that was used as first and second stage accumulation before rallying up to make a smart money reversal, your question is during the sell side of the curve, when the market's going to now drop down to the original consolidation, do we pair up the first and second stage accumulation on the other side of the curve for first and second stage distribution and redistribution? Is that your question?
Correct.
That would have been a whole lot easier if you would have just said that, because all the other stuff, I'm not sure if you were just sharing observations. I don't mean to be rude or anything. It's a lot. It's a lot to go through, and I'm trying to be very succinct and direct with my replies, because I know there's a lot of people that may have common questions. But in the future, anyone else, and please don't be offended by what I'm saying. Like, it takes a lot of time out of the day to do these types of things, and I want to get as many people as I can to ask a question, because one question might answer like 50 emails that come to me in the day after I do a lecture or a presentation. So it actually helps me. That's why I'm doing it. I'm not getting anything out except for lowering the workload of responding to other people who's going to have the same question. But to answer your question, yes. The perfect symmetry is going to be first and second stage accumulation will pair up with and show a reversal of roles, an inversion aspect of whatever was utilized on the buy side of the curve will be implemented in the opposite side on the sell side of the curve. Vice versa. It doesn't matter if it's market maker buy model or sell model. That's why it's not Wyckoff, folks. It's simply nothing like that. And the PDA rates that I'm teaching, Wyckoff doesn't know anything about that. He never mentioned anything like that. But if you carry them through price action, you'll see them implementing that. You'll see it. That's how I identified the inversion fair value gap. Like, it's like carrying the information over to the other side of the curve. I'm like, oh, wow, well, there it is. But supply and demand would never use that logic. It would never use it. It would never consider that at all. And it's not support and resistance because it's not a level. It's a very specific, I'm sorry. Yeah, it's not a level where it's like an old high and old low. It's inside of an inefficiency, like a consequent encroachment or it's the high of a fair value gap, which it's clustered inside of a group of candles. So how are you going to ferret that out as that's the support resistance level? So to answer your question, because I'm already getting long-winded about it, yes, it's true that the first and second stage accumulation will match up and pair up with in an inversion aspect on the opposite side of the curve. Doesn't make a difference what side of the coin it is, if it's a market maker buy model or market maker sell model.
That was more than enough. Thank you. Fight Club rules. I will give up the speaking now. Thank you.
Let's keep the conversation going, keep it flowing. Please come up here, be succinct, be direct. We're dealing with some very technical things here, and we are this form of administration here, so the questions you ask are important. Come to the table with a good question, pretty please. We've got a lot of folks here, and per even Michael's request, we want to cycle through these questions quickly. So, love you. People, come in, be succinct, direct, and we move forward. Gerald, I was getting to you. We didn't finish up with you.
Thank you so much. I have from today's lecture, basically what I learned is when you look at how price opened from their opening from regular hours opening range gap high, I was watching price as ICT was talking, and I followed through all the candles. When it came to patience is one of the things I tried to learn from today's lecture. When I looked at how these candles printed from 9:30 up to 9:44, ICT was explaining how patience is important. I'm just wondering how we would know that price would not leave that place. So when that candle of 9:46 a.m. printed, I got impulsive. Personally, I got impulsive, so I went short, and my stop loss was 35 handles, but I was taken out. So I just watched price drop as ICT had explained. So I was like, if I had waited a little bit longer, today patience, that is the demon I failed to fight today. But it was all good that I witnessed how price delivered until it closed up that gap. Now my question is, because I've been following the recent lectures with the core content, I've been adding in a few things. So my question is, does ICT still apply commitment of traders and the open interest when analyzing these range bound markets? Because we've been stuck in this range for a while. Does it still apply? I think that's it. Thank you.
I mean, Michael, he patiently waited to ask the question. I mean, I feel like we kind of went over that yesterday a little bit and kind of dealing with stuff, but I mean.
Yeah, I also want to just address something also. We have a common understanding, I thought, going into this, that when I was going to do the live streams, that after I do the live streams or during the live streams, that's why I don't open up the chat. I'm not hiding from anybody, because everybody can come at me right here, right now. They can come at me on X. Everybody can see their posts. Okay, I can't hide from anybody. So if you have something you want to say, you can say it. But I don't want to have anyone show me that they're trading with my commentary, because immediately what's happening, like, I'm going to be honest with you right now. Like, I want to leave the stream, this podcast that we're having right now, because I'm pissed off, because I'm hearing a man tell me that I'm listening to the ICT, and I went in there and I was trying, and I went short like he was saying it was going to go. Right away, immediately, I want to unplug.
Oh,
because
yes. It gets the hackles up. That gets the hackles up. I understand that, Michael. And I don't think they're so wrapped up in themselves that they aren't cognizant of what's happening here. And that was a perfect example to your point. I didn't mean to interrupt, but I just wanted to agree.
No. I want the people that are listening to understand my position on this, okay? I want you to succeed. I want you to do well. I want you to be profitable. I want you to avoid losses, okay? I want all those things for you. But when I'm watching price action, I have zero emotional commitment to it. I have nothing. I have no concern, because I'm going into this with the assumptions that everyone listening to me, like I said today, this is not trade advice. This is not for you to copy and go into trades with, okay? You should be submitting to watching what I'm outlining, so that way you do these things on your own And then your model will convince you that what you're doing is fruitful. And then at some time in the future, whatever that time may be, how long it's going to take for you to do it, where you trust that you've been doing the right things enough times, the outcome, the feedback that you're getting is showing you that this works. This is how many times it's failed in your own hands. This is how many times it's worked in your hands. You'll make a decision whether or not you're going to put money at risk behind it. I will never have anything to do with that. But as soon as any of you bring me into the fray of now my commentary is going to affect you monetarily, I'm unplugging. Like, I have no interest in that, because what you've done now is you've given me a perspective on the outcome of the marketplace that now has an emotional commitment to me. I have to be right. I have to protect your trade. I'm trading your trade for you. I'm not a fund manager. I'm not managing anybody's trades. So there's a perfect opportunity right here for all of you to understand how, if we want to continue with this, if you want to see me come out here and live stream, and I have every intention of doing this until I don't have any free time to do it, because my grandson just takes more time than it. Right now, he's brand new. Okay. I don't have as much access to him as I want, but as he gets a little bit bigger, I will have more access to him. So I'm not going to be live streaming every single day. I might get maybe one or two, maybe not even at all certain weeks. But while I have time and I want to do it, I'm willing to come out here and do this. But as soon as you start telling me, hey, thanks for the ICT, I made this much money, or as soon as I heard you saying, yeah, I went in there and I took a short, boom, done, that's it. A younger me would have just signed off, and that would be
Yeah,
it.
that's literally Fight Club rules right there, boys. Like, you want to break Fight Club right there, that's literally it. That's coming in and literally shitting on the entire Fight Club and the whole reason why we're here. That's literally it. Like, when we say Fight Club, you can say about it jokingly, but there really are rules. And when you come in here and just disrespect the entire platform, the entire energy for what it is for your selfish gambling needs, it is distasteful, it is disrespectful, and it's very off-putting. It's very off-putting. And when you want to
Can I
consistently surround yourself in this vortex of good, and when someone wants to come in and shit on that, then that is the off-putting sense that Michael is stating for the uninitiated, or for the listener to understand. It's so off-putting, and that's not the energy at all that wants to be received or reciprocated. So that is, I mean, we've joked about Fight Club, but Michael, to your point, like, if someone comes in and says that, it's like, it's just so off-putting and distasteful and disrespectful that it sets a certain flavor to the conversation or to the mood that you don't really want to be in, right? So folks need to understand that's not it, period.
I understand that there's a certain measure of excitement, and you want to feel what it feels like in your hands, and piggybacking on my experience and commentary is like the surest thing to get there. I understand that. But here's the thing. That can be accomplished by never telling me about it. That's what you're not getting, okay? I need you to leave me out of that equation. If you're going to do those things and not listen to it, the sound advice I'm telling you, don't trade on this right now. Learn from it as a pattern, as a procedure, a standard operating procedure going forward. This is how you do it. And I'm walking you through this year from the beginning steps of this is what you're supposed to do, to watching it, to anticipating it, to demo trading and live trading account entries. Okay. But you already are showing me that this is something that I'm probably not going to do, because you're making it emotional for me. I don't want to have an emotion. I don't care less what these candlesticks are going to do. But now, because I have somebody probably can't even afford to take a $20 loss, now telling me that they're in there and they did something wrong, right away I took a trade and I had problems, and I acted on what ICT said was going to happen in the marketplace. So how am I going to interpret that? It's my fault. And I'm going to wrestle with that when I'm watching the candlesticks over live streams, when I'm never really feeling that at all, because I know what I'm doing. I have no fear of what I'm going to talk about, because it's my interpretation of price action. I'm not worried about the outcome. It's not something that's meaningful as a binary outcome of profit or loss.
It's a
And
classroom of
it's,
price, as you've stated before, Michael. I think it's very
yeah.
important for people to understand what you're doing, your intention, and why you're here. And you've said it multiple times throughout all of your mentorships. You, over life price, you are providing a classroom of price, not an array for folks to play the casino and to become a gambler over your voice. You are teaching folks in a classroom of price, and they need to be mindful and respectful of that. And I just want to echo what you're saying in that regard, brother.
I mean, to be honest, I mean, it's one thing because, we have a partnership here. We're having community, outreach with everyone. It's one thing for me to say something and it's like, okay, yeah, it would be perfect for me to agree with him because it shores up the partnership and the friendship that we got going here. But be honest. Yeah. Am I saying something that's unreasonable? Is it fair for me to have
It's
this perspective?
extremely off-putting and distasteful for some young, inexperienced trader to come up here and literally talk about them playing in this gambler's field of what the whole intention and energy of what you're laying out, what this is for, someone completely ruining. And it is an energetic field that you're laying out within a classroom of price and where people can learn and how to not damage themselves, to really, really utilize the opportunity to study and learn within demo over a voice, right? And to be patient with yourself and these markets. And for someone to come rushing in to say that they're engaging in the market over all of what we're doing, it's extraordinarily disrespectful.
There's a way to do this, folks. Okay. And that's why I said, we don't talk about what we're doing. If I'm doing a live stream, if I teach a lecture, that's not an invitation for you to come on to my X feed and say, thanks for the heads up trade ICT. I mean, I'm not going to like your post, man. Like, I'm not going to like it. I'm not going to retweet it. I'm not going to congratulate you because you're literally doing the very thing I asked all of you not to do. You're placing an emphasis on me being absolutely perfect in an environment right now where I'm personally being challenged. Like this is not easy for me. It may look like it's easy, but I have to think about things a little bit more and weigh out a lot more factors.
I can tell. I see it. And it's just not fair that folks do that. Yeah, it's not fair that folks do that.
If you care enough to learn it properly, and if you care enough about me as a mentor, and you want me to excel and have my best hand forward, giving you everything I'm willing to teach you, unreserved, just follow the rules, man. Don't talk about what you're doing with your money. I don't want to hear about it. I can't spend your money. I can't take your loss away. And I'm not going to take the credit for anything that happens, whether it's good or bad. You pushed yourself into those trades. If you make money, keep it to yourself. Tell your friends and family about it. I don't want to know about it. I don't need to be inspired by it. I know my stuff works. You're the one that's looking for that. And by you having some kind of a feedback from me and congratulate, high-five you because you made money, that's not going to happen. I don't want that to happen. I don't want that to be the dichotomy between us as a mentor and student. I don't care about that. The money is the last thing on my mind. I could care less. I want someone to come forward and say, you know what? I learned something today. This is what I learned. And if you made money during the trade or the session and you copied whatever I thought was going to happen in the marketplace, please keep it to yourself. Like, I don't want to hear about that because literally what you're doing is going to make me clam up and I'm just going to wash my hands up and be done.
Community engagement is a classroom of price, ladies and gentlemen. That's what he's saying very clearly. We're in a classroom of price, and he's very okay being a teacher talking to students who are interested and passionate about learning and learning about his concepts. He wants to teach, and he wants that feedback. He does. This is all wonderful, but we can't have people come in and do exactly what has just happened. It's very disrespectful, and I 1111, love the time, want to reiterate exactly what Michael is saying. And that is, don't be disrespectful. This is a classroom. It's going to take you a long time to learn, and one day eventually you're going to be successful at this. You need to take what you're learning, these concepts, these lectures, this lecture series, the YouTube, and you need to treat it 100% wholeheartedly where and how it's being delivered. And that's as free education for you. It's free. It's education. It's technical information that you can consume and digest. What you do with it is what you do with it. They are concepts that are effective within the marketplace. And that's painfully obvious. We love that term. But when you come here, you have to understand this is a classroom of pricing. You're talking to your professor. You're talking to a mentor. You're talking to someone who has a genuine concern for helping you. And this is a very intimate forum. So when you just come in here recklessly and blindly want to be immature, irresponsible, and disrespectful, we all get to feel that. We get to feel that. And what you don't realize is what that is, especially when you're dealing with empathic, intuitive people who are, very in tune with dealing with a lot of people. So it needs you to be mindful of this. And I'm picking up what Michael's saying. Michael, you are 100% totally inbounds, reasonable, wholeheartedly. I'm not just saying that for saying that. I feel what you're saying. And for us to succeed at doing this at scale, we need folks to play by the rules. And those need to be very clearly defined, as you have done, as we have done, just like as trading. These if-then logic trees, these statements, you're in a classroom. You can't come here with your gamblers are us wanting to make money because you're a Fortnite trader and inexperienced. None of the knowledge base that's here is meant for you. It's for the folks that care about wanting to learn so that they can improve their life through decisions that they're making. That is the intention of the conveyance of this information. And I'm passionate and kind of fired up too, Michael, if you want to know the truth. I feel you.
I kind of hope the rest of the community can see it for what it is. I'm sitting out here, and I'm willing to tell you the PD arrays that the market's going to use. When I was a little apprehensive talking about the breaker this morning. I was like, I know as soon as I say it, people are going to put short orders in. I discounted it, moved it aside, and continued on with the commentary. I want to be fluid about what I'm saying and what I'm seeing in price action, and not have any reservations on how many people are going to take this as an entry and how many people are going to over leverage because their prop firm says they can do this many contracts, and because of the volatility being what it is, they're going to assume that it's good enough to enter and it's going to have a little bit more pain than they're willing to because they over leverage. Now I'm suddenly thinking about that and not reading price action. Like you can't understand that if you're brand new, but I don't think about the outcome when I'm taking my trade. I don't care. I could care less. I'm looking at a process. I'm looking at PD array. I'm looking at where the risk is defined, and I'm watching price action give me feedback to support it. But if you shove things in my concern that are going to be barriers and blocking that focus, I'm not going to come out here and waste my time. Like, I'm not going to do it. I can sit in my quiet space of my own home, make all the money I ever want, and none of you have to have any engagement with me at all. And I'm okay with that. I've made a lot of lectures that people have used and made millions of dollars. But I want to give you as a community a very intimate experience where so many people has asked me to do this, and I'm doing it. Where do I start? How do I do it? In price action, over live candlesticks. This is what you should do. This is the realistic approach to doing it, where you're going to watch me graduate right into a demo account, after doing tape reading, going into a live account, and you're going to watch me run this thing up, okay? But you're going to ruin it right away from Jump Street because you want to talk about what you did in your account. I don't care what you are doing in your account. I don't care. I really don't care. What I want you to do is learn. Learn. Be appreciative. Say thank you if you feel like it. You don't have to say thank you, but I don't want to know what you're doing with your money. That's the deal breaker right there. I don't want to know about it. If it's good, if it's bad, it's your results. They're not mine. I can't fix them for you. I'm not going to share in the joy of it. If you made lots of money, I could care less. I'm indifferent to it. And that's what I'm trying to teach you. Be indifferent. If I make a lot of money, who cares? You can't spend it. If I take a loss, you didn't absorb it. I'm going to take a trade. I'm going to get stopped out. And if you see that and you parroted what I do, you're going to share in that loss. Then you're going to have things in your head saying, should I be doing this? Did they change the algorithm? Are they going for his stop? You're going to be thinking about things that have no basis on what you should be considering while you're developing, because you're putting money in there. So just go along with the process and procedure that I've outlined, please. Don't talk to me about what you're doing with your trades. I don't want to know about it, okay? So if we can move on to the next one, I'd be willing to do
Absolutely.
that.
Absolutely. Geez.
Can I jump in, brother?
Yes, you can.
Thank you, Kit. I have a few questions for Michael or Kit, if any of you would be kind enough to answer. So the first one is, during today's market session, we were having around 20 minutes of high resistance liquidity run. So my question is, how do we anticipate this beforehand? Or how do we know that, okay, this high resistance run would last around this much time? Or is there a way to anticipate these kind of high resistance runs in the
Yes.
marketplace?
Well, today we had the distortion of the economic calendar that usually sees the non-farm payroll numbers released on a Friday, and they were released midweek. So that I explained that in the live stream, that I'm interested in observing and learning today how the market's going to behave given the uncharacteristic date of delivery for that employment data. So that in and of itself is going to invite time distortion, which will equate to high resistance liquidity run conditions. So you can anticipate high resistance liquidity run conditions around the economic calendar.
Thank you so much, Michael. And I have another question which is not related to today's trading, but is a technical question. So there are times where we see relative equal lows. So market makes one low, second low that is relatively equal, and we anticipate third time that market would run through that lows, but it takes 3 times, 4 times, or 5 times. Those lows are not taken away and are left for another time, and it would be days or even weeks after the market would take away those lows or highs. I want you to ask the question that, is there any way to anticipate that these relative equal lows would not be run? Or, by the way, I have made a habit to take a partial before those lows are ran away. So there is, I am getting out of that trade profitably, even in the conditions that those relative equal lows are not run. And I wanted to add something to the topic that Michael was
Can I answer your question
talking about earlier.
before you do something else? I want to make sure I can answer your question, because if I have an answer in mind and I'm going to listen to something else you're going to add on to, I may lose that spice that I have right when I want to deliver it to you. So you asked the question about how do we know the markets are not going to take these lows out? Why would they hold them for a later time? I'm going to assume that you're referring to most recent price action. And if you look at the daily chart on NASDAQ, they're holding the indices in a very large holding pattern. Something really big's coming this year. And once it unravels, we're going to have really, really nice, like today's price action, it's going to be like the steady diet. And then we'll go back to maybe 1 or 2 seek and destroy days a month, and then 1 or 2 consolidation days. But the rest of it will be just easy runs, open lanes of traffic, and it's going to be fun. It's going to be easy. Okay. But we have to weather that. When the markets are being held in large consolidations because of the holiday season, see, you're feeling what I've always taught around the holiday sessions. You're looking at holiday volume type of events. Does the market move around? Sure. Can I get in there and can my students get in there and trade? Sure. But if you're demanding today's level of finally releasing and having really nice clean price action, it's going to frustrate you. They'll leave lows intact and they'll just stay inside of a range and bang around, because you're in a time when there isn't a lot of deep pockets in play. Meaning at the beginning of the year, at the end of the year, no large firms are coming in and allocating new funds. They're not doing it. They want to get the tone of the marketplace, which is why I always stay out to the first Tuesday of February. First Tuesday of February, then I come back. Okay. And it just so happens that here we are yesterday. It had a little bit of movement, but it wasn't as nice as today. But this is about right. We're seeing that same return back to clean price delivery. So to answer your question, to the point, around holiday seasons, you're going to see those types of things where relative equal highs and lows, they don't get ran through. But they will offer, if you're astute enough, if you're trading them, and that's the draw on liquidity, take something off. If you're going to trade in holiday volume, or if you're going to trade in January, I got a lot of testimonies from people in the last couple of weeks saying, you know what, I'm going to start doing what you do. I'm going to only start trading in February because January chopped me up and beat me all up. I made a lot of money and I lost a lot of this and a lot of that. That's why I went through the same stuff, folks. I'm preaching what I endured myself. So when I tell you I'm not interested in pushing a large degree of money in the marketplace in January, it's because I have felt the pain of losing. And my losses are stemming from times of the year where it's not conducive to see this really nice run in price action where it's just so obvious to see what it wants to do and precision elements are there. You're just seeing the fruits of forcing something in an environment that's not going to give you that liberal price run that we expect when it's in low resistance liquidity run.
Wonderful, wonderful, wonderful. New faces, new people coming up. You know the rule. Want to hear from you, want to hear from new voices, different folks, and want to find out your thoughts and 2 cents. So bringing up new folks, you'd be like, but Kit, you bring up the same people. There are some folks that are the same, but I know that they're going to add value. So that's why we do that. But with that also said, we want to include more folks. So SEP has got his hand up, Forex trader, market researcher.
Hello,
How
guys.
are you?
Hello, ICP.
Hey guys, can I break in just for a second and invite you all as you're talking? Take a look at the NQ. Okay, I showed you the suspension block on the daily chart. Look at the reaction at the lows intraday today. Where that transpired. Look at that reversal right there, and we're back in almost half the range that delivered on the downside. It used the low of that suspension block on the daily chart. So you have to have these higher time frame levels to frame the furthest extreme that you'd be willing to hold on to. You know, sure, could it have went through that and just fell out of bed 800 more handles today? Sure, it could have. But is it reasonable to anticipate that your business hours should close up shop and be content with that full run if you were shorting at the breaker today? I want you to be mindful of those levels because it's not just simply me saying, look at this, here's some gradient levels. How far did it run before we had that sizable reversal and retracement intraday? It went down to the low of that daily suspension block I outlined in the live stream. But anyway, I'm sorry, I didn't mean to break the flow.
No, just no break in flow. Just a continuation on what you said earlier, having had indeed transpired and what price is doing. So, very, very, very nice follow through on that. Chris has got his hand up.
What's up, Kit?
How's it going, buddy?
ICT, thanks for having me on. So my question comes from the 2023 playlist, and it's been a while since I've gone over it. But I believe you spoke about how if we're bullish, the order blocks are going to be best used or even mostly used under 50% of the dealing range. So my question is, if that is true, then if we see order blocks be used above 50% of the dealing range and we're bullish, can we create a new implied dealing range by putting the equilibrium on that order block that's being quote unquote respected? I backtested that a lot in old data, but I can't really identify if it's coincidence or if there's actual correlation there.
I'm not certain I understand what you're anchoring to. Like, rephrase that portion of what you're trying to outline a new dealing range.
Sure. So with our implied dealing range, when we forecast that to the expected terminus, instead of forecasting it to the terminus, I'm trying to put that equilibrium, that 50% of the fib, on that order block to say, okay, instead of putting it on that terminus objective, using that order block to identify a different terminus, kind of like not really a standard deviation, but used in a similar
You're utilizing a projection theory, it sounds like, but then you're keying one projection to another, and then that other is becoming
the low, because we're bullish, that low being put obviously on that low, and then instead of implying the dealing range to relative equal highs, I'm putting that 50% on an order block that's being respected because that order block's above 50% of that dealing range. Because somewhere in the video, and I could have just understood it wrong or I have to go back and rewatch it, but that the order blocks are going to be used under 50%.
Okay, I'm not confident I understand what you're saying. It
Mhm.
sounds like you may have confused something in the lecture because nothing that you're saying here makes sense to me in terms of what I may have said in the past.
Yeah, no worries.
Determinus is determinus. Okay, so that's where you think it's going to go. When I talk about the order blocks, the same way I talked about the market maker buy models and sell models, the first and second stage accumulation and distribution levels are ideally at or below equilibrium. That's going to be your highest performance market maker models. Segue right into order blocks. Okay. Same way with fair value gaps. Anything that's a PD array, what are you essentially doing? Anything below equilibrium when you're bullish, you're trading in what? A discount market. Go back to month one. Okay. And I'm teaching, elements of a trade setup. And then I go into details in the first 3 months of the 2016 mentorship. They're required. That's required learning. Like you have to know that stuff. And in month 4, the PD array matrix, it gives you that whole business of where do these things fit. If you're bullish, if you do most of your work, if you know where the market's going to go, the draw on liquidity, then you can do certain things to get shorter time frame implied dealing ranges. Like for instance, say you're looking at it on a 1 minute chart and say the range is, for the perfect example, you're bullish NQ and the run that you expect is going to be 100 handles. And that seems like nothing anymore today, but this for the sake of completion and easy follow along, say it's 100 handles from the low where it started, and inside that low in close proximity, you got in there on a long. And you think it's going to run up to a relative equal high that just so happens to be a perfect 100 handles. Once we get above 50 handles, you are now above equilibrium or at equilibrium. So if you have an order block that forms above that, I'm not actually really interested in seeing price utilize that at all because I want to see it quickly run to terminus and not have any retracements, no stop hunts, none of that stuff. But if it does touch the order block and it's in an upper half of the premium part of the range that you think is the range that's going to lead to terminus or implied dealing range, then that order block has to support price. It cannot be traded down to mean threshold or below. Like it absolutely has to perform. It's held to a higher standard than any other form of an order block. Whereas a order block in the lower half when you're bullish, when it's in a discount portion of the range that you think the whole entire run is going to be a part of, those order blocks, they can actually trade all the way down to the low of the order block and still be valid. That's the measure of willingness and acceptance that I will see with those. But as we get to the upper half, we're in the last few minutes of the race. So you can't give up any ground. So anything that's used for an order block, if you take the remaining range, okay, take that whole order block out of it. Whatever you see in the remaining range, draw that from the most recent low on the 1 minute chart to the terminus, and then go down to a 15-second or 5-second chart. And then you have a whole new dealing range that's implied there that you can utilize. Like it's a whole new price structure, but it's part of an existing run that should come to fruition rather quickly. I'm not sure if that satisfies your question, but that's what I got without having an example in front of me.
Yeah, that really adds to it, that last portion. Just one last clarification on it was that order block that has to be very utilized quickly in that upper portion. What I was trying to look at was if it is being utilized in that upper portion, am I able to forecast a higher terminus than what I am expecting? If it's relative equal highs and I see that order block, yes, it is being respected in that implied dealing range I originally had. If I move the equilibrium up, so then it is a maybe not official discount, but according to that implied dealing range I'm putting it is, then that new expected terminus is how much higher it can overshoot, which is just like a forecasting.
Yeah, I would have to you like scribble something out and send it to me on
Sure.
X and say this is because I'm not unfortunately I can't
Yeah,
visualize
that's
what
the
you're
part
saying.
No,
I'm
that's fine.
getting lost on too,
Yeah,
because, and
yeah.
I just want to reiterate what Michael has taught previously in month 4 of order block theory when he talks about projections. Typically, when you're looking for projections from higher time frames, you're going to be taking the top 3 or the bottom 3 kind of swings that create almost like that 3 Indian or that 3 soldier kind of pattern. And then you're going to be projecting those 2 or 3 standard deviations in the opposite direction. That is order block projection theory as defined by order block theory as defined by Michael in episode 3, month 4, minute 12.
Yeah, yeah.
Okay. So what
Yeah.
you're referencing is an order block projection from the middle of the range, and then you're changing, both the terminus and the equilibrium. Neither of what you described fall in line at all with order block projection theory as defined by the, standard operating procedure.
What I'm not understanding, so that way you can know this when you send me the example that you're trying to communicate and frame your question on, so that way it helps you help me understand you.
Yeah.
I don't understand what you're anchoring the new fib with the like what is the anchor points? And how would that arrive at anything higher than your original terminus? Like what is the framework that you're laying the fib on for the basis of determining a higher terminus?
Because if that low being the origin, and then that order block, if the order block is going to be utilized in discount, and I'm saying, okay, if it's being utilized in premium, then does that mean that that new order block that's being used in premium, can I move the discount up into that order block and make a new implied dealing range? But I can put that in the chart with an actual example and then just tag you on it.
Bear with me for a second. Go back to our analogy here. It's a 100 handle run. From lowest low, your entry somewhere around 7 to 10 handles away from the lowest low. You got in on a inversion fair value gap, something like that. And you think it's going to go to the relative equal high of 100 handles. That's your terminus, 100 handles. You're asking about an order block that would, in theory, be around 75 to 85 handles of the range, correct?
Even if it's at 65, 75,
but above equilibrium.
Yeah, and it's above that equilibrium, so now it's in a premium.
So now tell me your anchor points for the fib in relationship to that higher premium order block that's existing somewhere in the range of 85 and 65. Where are you anchoring?
The anchor point that is set at the low, but then the second one isn't anchored to anything. That's where I'm kind of calling it like if it's a projection, because that equilibrium is.
So that's a hope and a prayer model. That's what that is. I don't want to be funny or anything. If you have nothing you're anchoring it to, then what are you doing? You have to have something to frame it on. So if you say it's anchored to the low, and then okay, I think I understand what you're saying. The low you're talking about is the low of the original run start, the lowest of the 100 handles. And what you're saying is you're dragging the fib all the way up, so the 50% level is laying somewhere on that order block that's in the premium portion of the original 100 handle run.
Yes, exactly.
You're thinking that new range somehow will promote a run of another additional 50% of that Fibonacci to some forecasted higher high, right?
Exactly. It's not something I've ever traded in real price because, like I said, throughout my back testing, I was never able to say, okay, yes, that is actually something the algorithm is going to use or refer to.
No.
Or if you, perfect.
No, I'll say that all the time. I apologize not understanding what you're asking, but I did teach this. 0.5, negative 0.5 will give you half of the range. So the algorithm will go there. It'll go 2.5. Yeah, go ahead.
Yeah, perfect. Thank you very much. Thank you, Ken.
You're welcome.
Excuse me, may I share my observation through class? And I see a SMT between Nasdaq and Dow Jones, obviously between Tuesday and Wednesday, in the high volume imbalance that we see in daily time frame that Michael mentioned before. So I see the week should be bearish, and because of this SMT that we have between these 2 days, and also we have a SMT between this year and last year. I'm a kind of an older student of Michael, so I want to know what's your opinion about this kind of analysis. And
What's your opinion of what?
I didn't get the question. I'm
Yeah, I
sorry.
didn't. I mean, you came in, you
You
said,
say
yeah, I heard him say, I want to see the market go bearish. I've been trading with Michael a long time. I like trading SMT, and I was wondering what he thinks of that analysis.
no, sorry, I did explain it badly. I thought Michael asked about what we saw today and what we learned today, and I was sharing my analysis.
No,
I
that's fair, brother. And I know you're speaking in a foreign language, so we respectfully understand that. We're just trying to understand, honestly. Okay.
Yeah, the thing is, I wasn't in the class today, so what I saw, it was a high volume imbalance in a daily time frame in Nasdaq, and an SMT between Dow Jones and Nasdaq. Is it something that I can build a framework on it? Do you think?
well, yeah, obviously you can, but if you watch after this presentation we're doing, if you go watch the live stream that I did today, you'll see that I have actually mentioned nothing about SMT because it's not important right now. I'm trying to get everybody to get accustomed to reading real time price action using very simple procedures and points of reference. And then after you get really well equipped with that, then you can bring in, as I will later on in the year, I'll bring in things like SMT and things like that where it's salient. Right now it's not important. Okay, you can find trades without SMT. It's not imperative that you use SMT. It's not a be all end all. It's not a panacea. It's not the magic thing that makes the trades work. It's just another confluence, another supporting actor to a well written script.
Love that. Nizam Khan. Nizam? Nizam? Is that right?
Hi, can you hear me, sir?
It's a little muffled,
Hi,
but go ahead. Yes, sir.
can you hear me, sir? Hello.
Yes, sir. Go ahead. Go ahead.
I have a question from sir, and from yesterday. Sorry, this is a little out of topic, but
Oh,
it is.
Nizam, I can't understand what you're saying, buddy. So
I
you
am.
made it. No, you made it a point to reach out. You're very boisterous in reaching out. Ask your question to me via the DM,
Yes,
and
yes, sir. From yesterday, I am asking from sir that in few, I have completed my 12th examination. So for bachelor, what for bachelor, in what subject I take admission so that sir
yeah, I'm sorry,
related
buddy.
to
I'm sorry, buddy. There's a communication problem. I don't understand anything you're saying, so that's gonna be a
Send it in
problem.
text. Yeah, send it in text, and then maybe we can come back to
Yes.
it.
Yeah. Real quick question I have from a charter student, and he's asking, Michael, and it's a good question. I like it. 1040 on ES. The 1040 candle on ES, would you utilize it as a mitigation block? And I want to just reiterate, there are folks in the community that get confused with the mitigation block. So bringing that up real time that someone is asking is, I know someone kind of that feels that, like, I mean, the value and the importance of your mitigation block. And, and I don't know, I was just going to propose the
What
high.
is it
He
again?
goes, so 1040 candle on ES. Would
Okay, give
you
me a second.
utilize?
Give me a
Okay,
second.
yeah,
Let me
yeah.
get my ES time frame.
Time frame, I'm going to say 5 minute because the person who's talking to me really only uses a 5 minute. And he's saying would you utilize that as a mitigation, as a bullish mitigation block, the high? And he's one of your students. He's a charter and he actually loves trading the mitigation. So I find that fascinating.
1040 on a 5 minute
Yes.
up today.
Yes, sir. 1040 on a 5 minute on ES. One of your charters is asking, potentially, would you utilize that as a bullish mitigation block?
I personally would not, but I would use the range of the wick, the discount wick of 1010 of today on
Okay.
ES, March
Okay.
delivery contract. If you grade that wick, whenever wicks are in more or less a consolidation, my eye is going to go to that more than anything else because it's already graduated gap theory where you can slice it up. And if it's going to be bullish, it's going to use the upper portions of it. So at the 50% of it, or consequent encroachment of it to the highest portion. So having that, let me see if I can put this on here in my own chart. Bear with me, I'm sorry.
No, it's all good. It's a technical question referring to the chart. So
Yeah, if you look at the 0.625 level on that 5-minute discount wick, you'll actually get the very, very low tick on 1105, and then it starts to send it up. So to answer your question, no, I wouldn't use it as a mitigation block.
okay. But you did grade that wick, or did you grade the following the 45? Was that what we were referencing?
The wick, I would not use that candlestick that they're asking for.
Okay. Yes. Okay.
But
That's the first point. You would not use the 1040
the
as
thing
the
that jumped off
mitigation
the
block.
chart to me
Okay. Yes.
was the discount wick of candlestick 1010 for ES March contract on a 5-minute candle.
Yes.
And if you grade that, you'll see that at the 0.625 level, it comes in at 69,552 and a quarter. If my eyes are not failing me.
Yeah.
And then the 1105 low comes in at why am I not able to see that?
Right around 69.53, 69.53.50 on the 1105 swing low.
Hang on, my eyes are failing me.
Yeah, 69.53.50, I think.
The low comes in at 69.53 and a quarter, and the level comes in at 53 or 55 and a quarter. I can't make it out of my text. You can check my math on that on your end.
Yeah.
But that's I would have used that because it's in the upper half of the wick that's on the 1010 candlestick. And let me make sure I say this correct because I already know I'm going to have 1,000 questions because of this whole business right now. The market came down, made a low, and reacted and started to move higher. Inside that swing low, there's a wick there. Now imagine if that wick wasn't there at all on the 1010 candlestick on the 5-minute chart of ES March contract. Mm-hmm. If that wick wasn't there and say that SIBI would have formed on the 1015 candlestick, that would have been a inversion fair value gap, and that would be the PDA rate to anchor off of. But because that wick is there, it's sharing generally the 90% of the range that 1015's 5-minute candlestick. So forget that candlestick, go right back to the wick, and then grade that. If it's bullish, it's going to use consequent encroachment of that wick or another gradient level higher than that. And you can see that that's exactly what you're seeing here on the 1105 candlestick. It uses that 0.625 gradient level on the candlestick at 1010. And then that's
Wow. Totally see that. Totally see that on the 1010. And it's funny how you say that, because if the wick were any smaller, then that would have been an FEG that we would have found interest in, as you're pointing out. That would have then been an inversion. But because the wick was larger and it actually touched that other wick within the 3-candle sequence, you're foregoing the utility of the body of the candle 2 and utilizing the range from wick 1. So that's fascinating.
Why? Yeah, think about why am I doing it?
From a 3-candle standpoint, your
don't think that.
Okay.
Don't think that. What did
Okay.
I
Okay.
take your attention cut through to that 10-10 candlestick? For what
Yes.
purpose? What is the 10-10 candle illustrating?
It's sweeping the overnight liquidity. It's taking the first piece of the overnight liquidity. It's taking
No.
the
The
NWOG, the
actual,
first.
no, the
Okay, go.
candlestick in itself, the
Yeah.
10-10 5-minute candlestick.
Hmm.
Why did I pull that candlestick? What was the defining characteristic about that candlestick that I referred to? It's wick, right?
Yes.
So what did I teach you wick is?
Gap inefficiency.
Right. So cancel the candlestick to the right of it. That body doesn't exist.
Hmm.
What the algorithm is going to go back to is that wick because that's the gap.
Yes. Yeah. Yes.
You see it?
Yes. Yes.
I'm
Just
sorry, I have
imagine.
to
Just
interrupt. That's
imagine
so
this.
much sauce. It's just
Yeah,
so
that is quite a bit of
it's
sauce. When you
crazy.
look, it's kind of when you look, it's kind of crazy.
Yeah, he's
It
got another
is.
PD array, so there you go.
It is. No, it is. It really, really is. It's a great way for folks to anchor off of. And I mean, it's right where we have that close right at the daily open or there's the previous daily low where we're really in that NWOG as well. So we're looking at confluences and we just swept an overnight low. It continues within its follow through to take the monthly open and continue into further NWOGs before it flips, but you maintain that wick and that range as it prices to and through it. And then you would be becoming interested in this 1050 macro, the down closed candles that would be retracing back into that wick for a very good opportunity towards a trade. That's how I would see the way you were explaining that. I personally, I like the down closed candles into the graded wicks. So, but even coming up out of it, it's wow. Wow.
If there's a wick, okay, the wick will take precedence over imbalances. It will take precedence over order blocks. The wick is a gap. It's a gap. So if we have an instance like we have here where there's two candles side by side and the wick's to the left of it, disregard it. Act as if that candlestick to the right of it doesn't even populate on your chart. Just ignore it. And then visualize the range that the highest high and the lowest low of the wick is the fair value gap, which would act as what? Inversion. And how is an inversion fair value gap utilized when we're bullish? It trades above it and comes back down and respects the upper half and does not lay a body down in the lower half. Look at the gradient levels on that wick. It's doing the same thing because it's a gap.
That's just so mind blowing. If someone could put a screenshot and mention somewhere where we're at here, where are we? We're in the macro, ironically, 11:49 going into 11:50 here. Just the timestamp there, Michael. I want to just include that we are going into a macro here, 11:50. So we love that. Wow. Deep breath. I see folks wanting to. Let me get FX for Living back up here. Oops, that was sorry. That was meant to be the other one. FX for Living is back. Welcome back, David. Are you there, David?
Yes, sir. Can you hear me?
Yes, sir. We can.
Nice.
Thoughts and 2 cents on the mentorship. What you heard, what you're hearing right now, what you just heard as far as these wicks, grading these wicks, that 1010 price. What were your thoughts on that?
A lot of gems, right?
Yeah. Anything? Just I want to bring you or include you back in the conversation. Any thoughts, 2 cents on what you've heard so far?
I really like the smart money statement that I hear in this morning on the mentorship. Was something that I would recommend. Basically, just re-listen again and maybe translate that at text. So you can actually read it on your eyes and actually understand better what it mean by that. But that was pretty good. Really, really good.
I did like the referral to Smart Money, the repeated reference to Smart Money today.
Yeah, towards the end, I think that was like maybe 80% or 70% of the stream.
This is really good. Texas Trader.
What's going on, boss? Real quick, it's kind of a two-part question. I would love if you could walk me through your full decision tree from the central bank dealers range to the silver bullet entry. Specifically, like when the CBDR is established, what are your qualifiers at checkpoints like 7 a.m., 9:30 a.m., and then 10 a.m.? Is there anything that like
Wait. So you're talking about the formation from 1600, the close of the previous day, the close of the previous day's RTH, and then we have this overnight session into the whole new day's new 9:30 price, and the silver bullet formation. You're referencing the 10 a.m. silver bullet.
correct?
So you're wanting to know the SOPs, the specifications, the standard operating procedures, which are clearly defined within the lecture series. You'd like us to repeat that for your edification?
I'm looking more for a particular more so
What are you struggling with?
probability. The
I want to know
probability.
what you're struggling with.
So when your video yesterday, you talked a lot about when price runs the central bank dealers range high in that 7 a.m. open.
I didn't say anything about central bank dealers range
Yeah, that's
yesterday.
the thing. I was confused to that too. I wasn't sure. What do you mean by the CBDR, buddy?
Are you talking about the opening range gap, the regular trading hours opening range gap? I haven't
No,
even used central bank dealers range words, okay, in months. I haven't even referred to it at all in months.
sorry, I've been going through a lot of your content. I might have just mixed the two together.
That's okay, buddy. That's not
Yeah,
uncommon for what it's worth. That's okay. That's
yeah, that's on
okay.
me.
So
That's okay.
you said you watched the video that I did yesterday. Are you referring to the live stream I did yesterday?
Yeah, I was watching that video where you went kind of like from beginning to end without necessarily a bias, per se on like the higher time frame. You just were working out a way to essentially
Okay.
go ahead. Sorry.
No, I'm listening to you. I have to make sure that I understand what video you're referring to. So now I know what you're talking about. To continue, I'm sorry.
Yeah, so I was kind of looking at your qualifiers, and then I was trying to implement essentially all three levels is what I've been trying to do over like the last couple of days. In yesterday's video, I wanted to add it in terms of determining my direction that I'm wanting to trade in the morning, or finding like a short-term bias. I want to figure out the connection between the price levels of the central bank dealers range, the 7 a.m. open, the opening range gap open, not necessarily just in the procedure that we go through, but more so the probability of when this is swept, what is more likely to unfold next. Does that make sense?
I'm not certain I have an answer for what you're asking because I don't understand what you're really asking. It sounds like you have a bunch of things that you're trying to find a place for them. And that's
Mm-hmm.
like teaching you a model and teaching you concepts from the basic level. And put it this way. There are generic principles that I look for. And I kind of like outlined that today and yesterday. If I don't have a bias going in, then I have to wait for something to materialize. Today, we had a premium gap. So you know there's going to be an initial draw lower to at least mid gap. So then you want to see, does it maintain strength or in this case, weakness to continue going lower? So that in and of itself gives bias. We talked about a bearish breaker.
Mm-hmm.
So clearly it's one side that's lower. I have to wait and see what the market's giving me. So there isn't going to be like, this is what it's always going to do. It's going to give you an institutional order flow entry drill, and then it's going to give you a inversion fair value gap, and then it's going to give you a stop hunt that goes into a fair value gap that respects the upper half, leaves a small portion where there's a breakaway gap. Like, I wish I had it like that. Like, I wish I had it like that. But you still have to sit there in front of charts and watch what the real-time price action is going to give you. So I don't think there's like a bullet point checklist that it's always going to, it's not, I certainly don't have something that's going to give you a complete satisfaction of one shot, one kill, always works this way. It's going to be this way all the time. It doesn't deviate. And I kind of like, and I may be wrong, but that's what I'm hearing that you're asking for. And if it's you asking that, I'm being honest and telling you, I don't have it like that. I still have to submit to what price is going to show me and then utilize the PDA rates as they give it. Because not every PDA rate exists in every price run.
For sure. So let me rephrase then, because I definitely understand what you're saying. Maybe from a backwards perspective, when I'm at the 9:30 opening bell, what specifically is like your order of checklists in regards to previous sweeps coming into that session.
Go over your lecture again, pretty please, Michael, is what I just heard.
Well, give me a chance to have a little bit. Okay, what you want is to know with a little bit more than a hunch that you should be bullish or bearish. Am I correct?
Yeah, particularly in terms of looking at highs and lows of the day with
What
those
highs and lows
swings.
of what day? Of
Like
what day are you referring to?
of any day. Like if I'm going into the market,
Well,
I
that
establish my
doesn't work.
weekly
No.
range.
Please
I go through.
give me a second. Yeah,
Okay.
you have to tell me what day are you referring to? Like, because we look at a previous day high and low. We look at the highest high and low in the last 3 days. We look at last week's high and low. So give me a definitive, what high and low are you referring to?
Oh, sorry. Current. I'm trying to project current days, likely low of the day or high of the day, by looking back at our reference levels from the central bank dealers range, the 7 a.m. open, the 9:30 opening, and then using the silver bullet as a continuation trade, because that's what it is. I want to find my silver bullet trade with much more confidence that, okay, yes, I have put in place this low of the day because I can see where we've ran this, because you made it very clear on an older podcast, specific times when if we run these lows with this news connection, then this is the lows that are going to be targeting us. And you were very specific about the lows or the liquidity pools that you mentioned in that lecture. And so I'm trying to figure out if there's any more flesh on those videos or on that concept in terms of saying, okay, this is the next target because we did this, and I can be more confident in that low of the day forming or that high of the day forming, and that silver bullet I can actually stack more onto, because I'm really trying to go heavier in some of these trades, but a lot of times I'll get to take profit 1, take profit 2, and then it'll come back out and stop me out break even after I've taken partials off.
How much work are you applying to your daily chart?
A lot. I run a full at the beginning of every quarter. I'll go back and I'll run the full 60, 40, 20.
You don't need to go back that far. If you just look at the last 3 days, the range that's afforded to you in the last 3 days, you'll have every high frequency trading algorithm level that they're going to use majority of the time in the session you're in right now. They're going to just use the last 3 days. If you want to fancy dance it, go back the last week, okay, and envelop the highest high and the lowest low of last week, and they'll incorporate that as well. So it's not complicated. You don't have to do a whole lot of acrobatics and having a whole lot of range. You don't even have to go back 20 days, but 3 days is inside that last 20 days look back, right? Of course it is. So by having, for instance, a greater appreciation for like the suspension block that I annotated and referred to, I had that on your chart. If you see that, those levels, they have a volume imbalance at the top, they have a volume imbalance at the low, and you have the entire range. So you grade that. So if the market's showing willingness to try to color outside the lines of that suspension block, like it did by going into last Wednesday's regular trading hours opening range gap, as I defined yesterday and utilized it again today, that was the little barrier outside of the suspension block on the daily chart. So it just colored outside lines just a little bit, but it didn't leave anything up there. It rejected that. So if it's rejecting that outside of the suspension block on the daily chart, and it's also rejecting the higher volume imbalance of the daily suspension block, what is it indicating? Is that bullish or is that bearish?
Okay, I see what you're saying.
If
So
you do, then you'll answer the question I just gave you. Do you see that as bullish or bearish?
For which one?
By having a market like the NQ did, it traded outside of the daily suspension block that I highlighted and taught today. And it traded outside of it yesterday and today by only going to last Wednesday's regular trading hours opening range gap high. It traded inside that range, which was outside and just above the daily suspension block. But they rejected that by going lower into the daily suspension block. Then in the upper portion of the daily suspension block, there's that volume imbalance. It was rejecting that also. And I was mentioning a very specific PD array in the live stream today. It's a premium array. So my question is what would you reasonably expect price to do? Act bullish or bearish at that juncture?
Well, if we're outside of that range, it would be at an extreme. I would expect bullishness.
Okay, there's your problem. Because what I just described and illustrated yesterday and today, it's an unwillingness to hold on to a premium, but it's respecting premium arrays. It didn't stay outside of the suspension block on the daily chart yesterday or today. It went there and then rejected it, went lower. Then we traded up into the volume imbalance on the daily suspension block of NQ, March delivery contract. Put those levels on your chart and watch what it's doing today. It's trading up into it, but it can't gain ground. It's being staved off. It's being suppressed, kept lower. So that's not bullish. That's actually bearish. So what is it telling you it's respecting? It's respecting that daily suspension block. So now you have to incorporate what levels? It's gradient levels. It's consequent encroachment. It's midpoint. If it overtakes the consequent encroachment or midpoint of the daily suspension block, then it's probably going to traverse the entire range of that suspension block. And look at the low of the session today. It's that low. So by incorporating, when I asked you how much work you're doing with the daily chart, you have to look at the opens, the closes, the highs, the lows. If there's wicks, grade those levels. Where's the consequent encroachment of that? I understand you want, just like I wanted, give me the very simple 4 or 5 step process that this is all I got to worry about. But we're in a market that's range bound. So you have to have a lot more things in play or wait for more liquid running markets. And that choice is going to be yours. So if you're frustrated, if you're struggling and you're seeing 1 or 2 profit objectives being met, but then it comes back and stops you out, that's the same thing that would have happened to me if I would have been pushing the envelope in January. It would have happened to me too. So don't look at that as, oh, well, I'm not doing enough or I'm not doing it right. You're just pushing too hard and demanding too much with not enough information. Just slow down and try to have a little bit less in terms of what you require for your trade setup. And that's what I'm trying to focus on that this year. So hopefully what I'm teaching this year will help better communicate my response to you in practical terms over live price action.
Okay, so you feel like I'm definitely trying to look at too much in every single
It
situation.
sounds like you're trying to bring too many things when you only need one selection tool. Okay, what is that? What's telling you that you're bullish or bearish? Well, that's going to be derived from a weekly and or combination of daily chart. What's it reaching for? The inefficiency above or below the marketplace, or liquidity above or below the marketplace? What did it recently just take? Did it take liquidity above? Okay, if it's done that, then first protocol is, okay, where is it going lower? If it's took those stops, it's a false breakout to the upside, then it's going to look for something as a discount. So first order of business is look for inefficiency in the previous range that ran up to those highs. And if it's an inefficiency that is warranting enough of a range for you to be short and have a nice profit, then that's something to consider. And you don't need to even run to the opposing liquidity, but have that as a best case scenario. So you can do a partial at the highest level of the discount fair value gap that it would be trading down from to get into a discount market because it just took buy stops. This is done on a weekly and daily chart, by the way. So this is what I'm asking, how much work you're doing on a daily chart. By having that, it removes all the concern about, I need to know what the right bias is. That's the right bias. But not every session is going to be in alignment with going lower. You may have a London session that really drops heavily, but then New York may retrace and then consolidate in the rest of the day. And you think, well, it's no longer going to go any lower because you're looking for lower time frames. And you're disregarding the larger context that the weekly and daily chart is affording you by having your focus pressed into that perspective and not something on a lower time frame. So, and then leaving a runner with a wide stop, that means don't strangle it. Take your profits and partials, but leave your stop just covering costs and just let that happen. You've already profited by taking partials. It's not important that you have a lot of money come off from the final portion because it's an insurance policy. The insurance policy has been paid for. You want to see if you can get to that best case exit strategy, which is the opposing liquidity that you derive from the daily chart. Then that's going to be an open high low or close or a consequent encroachment of a wick or inefficiency on the daily chart. But you have to do a little bit more work in regards to that level of stuff, not just simply look for central bank dealers range and opening range gaps. And like you're in a lot of focus for the smaller time stuff, but you're bringing too many tools that is not necessary. Okay, and I'll use this analogy and I'll end it. Bob Ross has his 3 favorite paintbrushes, but he has a whole toolbox of tool brushes. He doesn't go in there and try to use those 3 paintbrushes to do the same thing. He doesn't reach for all the other ones either. He knows what he needs his one particular paintbrush for: fine lines, a fan brush, and the wide bristle brush for the majority of his canvas to do the initial foundations. But most of it is just those 2 smaller paintbrushes. But what did he spend the most time with? Preparing his canvas with that big brush. The big brush approach is spending time on that weekly and daily chart. And then once you have that outlined, what do you see? What's he going to paint? He's going to paint a landscape. Okay, is it daytime or is it nighttime? He prepares the canvas with that shade of color. Then he goes in and adds all the little detail. That's the central bank dealer's range. That's the opening range gap. That's the silver bullet. But if you don't have the context or the canvas properly presented and prepared for the other things you're adding to it, it's going to be no surprise to you why you're struggling and the little time frame stuff isn't working for you because your larger time frame perspective is out of spec. Does that help?
For sure, for sure. I was a charter member in 2020, and I really went through a lot of the higher time frame stuff, and I was successful with it. But lately this year, I have been trying to ring in a lot more of the lower, like really micro level things. Hence why I'm really just kind of set in on the central bank dealers range. Like even today, the high and low formed on the second standard deviation. Like maybe that's just a today thing. But like those are the little nuances that I'm trying to ring in now because I can get in line with order flow fairly easy, especially when ringing in those higher time frames. I'm thinking about these choppy markets and trying to get scalps based on very, very short term premium and discounts and trying to identify whether we have a false breakout or it's just a run on stops only on that shorter time frame. But what you're saying is I still need to have that higher time frame stuff present.
Always.
Okay.
Always. Always, always, always. That has to be there all the time. I assume when I'm doing my lectures that the majority of you are doing that. So it helps me save time instead of going through the process. And then look at this on the daily chart. That's why I said last night, is your suspension block annotated on your chart? So that way when we go in here today, you should already have it on your chart and you'll understand what that orange box is. And it just alleviates a lot of time that would be wasted otherwise with something that's simple as this. It's already on my chart, ICT. Let's go. If you also have been trying to push real hard with these lower time frame things, these tools that are for precision stuff, if you've been trying to push that in January, this is the reason why I stay out of January, because the precision elements are going to be muddy because there's a lot of manipulation during the month of January. Don't push so hard in January. As we get closer to March, the things you're looking for probably will materialize a whole lot cleaner for you.
Okay, awesome. Well, thank you. I appreciate your time.
You're very welcome, man.
GCW Outer Square Trader. Michael, it's 12:09. How are we doing?
12:45 will close, okay?
Yes, sir. Yes, sir. The Outer
Hey,
Square.
can you hear me?
Yeah, brother. Go ahead.
All right, man. Well, Kit, thanks for what you do. And Michael, your generosity is legendary. I've been listening to you for, 3 years or so now. I take what you teach. I go try to learn it, put myself in a hole and learn it for a while and then come back. One thing I've struggled with repeatedly is just kind of finding a balance between liquidity pool draws and in-wogs and in-dog draws. If I remove all the candles, it's really easy to see how powerful those gaps are. And just incorporating that into my analysis, can you give me I know you've talked about this and it's probably because I'm retarded. I don't quite get it, but can you give me a sort of a general idea, an analogy? You're really good at those analogies of how should I frame that in my head? Because sometimes I get it right and sometimes I just don't. And it's just hard for me to gauge the different strengths of draws, particularly liquidity pools and the gaps.
Well, if you have the last 5 new week opening gaps on your chart, And there's your canvas. That's your highest high end log, your lowest low end log. Okay. And then incorporate what you think the market's reaching for on the weekly and daily chart, just by price alone. Did it just recently take liquidity on the weekly and daily? Is it gravitating towards a clear, obvious little imbalance that might be reaching down into it? And does it afford you 100 handles or more? Then what you want to do is go down to the lower time frames and then refer to any one of the most recent new week opening gaps. If it's reaching for something lower because of the weekly and daily chart, we're assuming that we're bearish now because of that. Waiting for price to run up into an NWOG and then respect it by staying in the lower half of it. It can throw a wick up in the upper half of it, or it can trade up in the upper half of it, but then leave it again, go back below the low of the NWOG, and then trade back up to the consequent encroachment, or fail to do so. The next fair value gap, just use that as a draw to your daily or weekly inefficiency. You can play ping pong, literally have no bias at all, zero bias, just trading every reaction off of every NWOG that's happened in the last 5, and just simply study. Take everything off your chart. All of you should be doing this. Take everything off your chart and just put the NWOGs on and just study how price reacts. How many times are you getting a setup? You're not getting a setup every day, but you're getting intra-week price runs for several hundred handles. You're getting a forced perspective of patience because this is the only time you can take a trade. And if you are trading against the higher time frame bias that you could arrive at by using a weekly and daily chart, trade with one contract. But then do your regular high-end maximum leverage when you're trading in concert with your high time bias, where you're reacting off of one NWOG and trading it to another one as a target. Like, there's so many ways to skin a cat, man. Like, there's so many ways to do this stuff. And I'm concerned that when I present something, when I teach something, because the folks that listen to me have like this almost like a, it is cult-like. It really is. It's kind of weird. But you think that everything I'm saying somehow supersedes and improves upon and makes the previous stuff irrelevant and it's obsolete now. So this is the only thing you got to worry about, or add this and it's all going to suddenly become easier for you. And you got to go back to step one, which is, why should the market go up or down? It's going to have a reaction off of absorbing liquidity above old highs or below old lows. Right away, you have a test tube right there. You have a laboratory experiment. It just took out an old high. Does it continue, or is it rejecting it? If it rejects it, then what do you have? You have a likely 2022 model. What's the closest proximity, new day opening gap or new week opening gap from that high forming? What's the closest one? Aim for that. And then the nearest 25 or 30 handles swing low or inefficiency below that. Take that as your first partial, move the stop to cover cost, maybe a pizza dinner, and let it go. There's a model in and of itself there. Like, there's so many ways that you can trade liquidity because it's all over the place. Like, there's so many opportunities. There's no limit to what you want to do in terms of framing your model. But unfortunately, what happens is, and I see this a lot, so it's not just something that's unique to you. Everybody wants to have the perfect model. The perfect, never losing, always easy to do. It's going to be the same way each time. And that's all they got to worry about. And they can disregard all this other stuff. They don't have to worry about 80 more PD arrays. They don't have to worry about another, bias techniques. It's just this. It's because they had not spent enough time doing something as boring as looking at one selection tool. What's making you bullish or bearish? Are you going to be a liquidity or an inefficiency trader? Answer that for me right now. Where are you finding yourself drawn to more? The gaps or highs and lows where liquidity exists?
The highs and lows, there's no doubt. Liquidity is what makes sense to me, like right away. Immediately it did.
Okay, so now we have that out of the way. What is your technical entry model? What's the PD array that puts you into a trade? What's the thing that gets you into a trade?
I look basically for the 2022. I look for the displacement and the return, the fair value gap, and enter there.
Okay, so you're looking for a premium fair value gap in the displacement leg after a run on liquidity.
Yes, that's that's what I really like. I feel good about those.
Okay, so when you see those setups, Why are you even considering that trade? Where do you think it's going to go?
I'm looking for, well, after it's just taking liquidity, I'm looking for an SMT reversal. That's what I'm looking for.
No, don't even worry about that.
No.
Where is the market going to draw to? What do you want it to go down to? If you've taken
Oh, the
time to watch the
draw.
market, yeah.
Gotcha. I'm looking for some displacement down further that it's going to reach down there. That's typically what I do. Where's a big displacement candle, and I kind of use that as a target, or
Okay,
50% of the range, something like that.
Okay, what range?
The dealing range that precedes it, that brought it up there to take the liquidity in the first place.
Okay, so let's assume for a moment there was a 300 handle run that ran that high out, and then it created a false breakout, and then it displaces lower. It leaves a fair value gap, so you know you got an entry for a model 2022 entry. You have a defined easy placement of a stop loss, and now you're looking for that 300 handle run up, that price leg that went up there, created that reversal or potential reversal. You're aiming for 50% or potentially around 150 handles, correct?
Yeah, more or less, yeah.
Okay, now what would happen if you have a new week opening gap high that's just about 20 handles below 50% of that range that you're talking about? Would you just get out of 50% of the range, or would you aim for NWOG's high?
In that instance, I would aim for the MWOG high, because
See how easy that is?
it's not going counter to my, yeah.
Right. That's it. All you're doing is taking the tools and placing them in their proper place. Every tool, if you've ever been around someone like I'm a car guy, and a lot of my neighbors, they have really nice cars too, and they have their little shops, and it's wonderful. They have all these tools. I'm not a mechanic kind of guy, but every tool has its place. And they always say the same thing. Every tool has its place. In trading, it's the same thing. You're going to look for an NWOG to support an idea, and it may give you a little bit more juice in a theory that you thought was going to deliver. And you're like, oh, you know what? If it's going to drop down there, the NWOG is going to have a whole lot more desire or draw or gravity, basically, to pull price into that than just some 50% of a range. 50% of a range is in and of itself nothing. But when you bring in a new day opening gap or a new week opening gap or an old an old regular trading hours opening range gap, because they're the same thing as a new week opening gap. They're the same thing as an NDOG. They are huge pulls of gravity where it drags price into it because it's forcing fair value in the marketplace. Whether there's enough buying and selling pressure or not, it's being drawn into that. So you've illustrated your potential to see it, and I was testing your decision making process by having a scenario where, yes, you know you're dealing with your model, you know how to get into the trade, and you know you're looking for a displacement lower. You want it to go lower, at least half of the range that it built up the sell off entry on. That's nothing wrong with that. In and of itself, that model's perfect. But your question is the NWOGs and what to do with that. Bring them in as an addition to something you already arrived through regular price action in the model you're trading with. And you'll see that they will drag price in and pull them into a farther objective, a best case scenario, exit terminus, that you otherwise wouldn't have considered if you were just looking at this half the range or it's just some kind of little fair value gap in the previous run up. Does that make sense?
Makes sense, brother. I appreciate it. That actually does help clarify.
Awesome. Thank you.
Thank you.
Keeping the conversation going. I see team mentorship follow through. I got Outer Square Trader, Juan, Nico, and Big Black Candles. We'll go in that order, please. So Outer Square.
Do you hear me?
Yes, sir.
All right, this is gonna be quick because my phone is about to die. My question is, Michael, real quick. I wrote it down because I want to be real quick because my phone about to die. Like I said, when time and liquidity conflicts, right? Which one does the algorithm prioritize?
Can you repeat that? I didn't get what you said.
All right. When time and liquidity it conflicts, which one does the algorithm prioritize?
On what basis is there a confliction?
Let's say, like like normally during a kill zone, price runs to liquidity and then delivers to displacement, right? When when there's a New York kill zone and you expect like a displacement, but there's an Asian high, let's say, and it hasn't it's intact right above, or the opposite. um, like if it's time for a move, let's say, but liquidity is somewhere else, which one does it win, like time or liquidity, if that makes sense?
Okay. It's always liquidity. Always liquidity. But the run to the liquidity will not transpire until it's the right time. So it's saving the protraction towards that liquidity until a specific time of day, inside of a macro, inside of a kill zone, something to that effect. It's always liquidity. Liquidity is the most important function of the marketplace. Without that, we don't get in trades. We can't get out of trades. So the time aspect is simply when we expect it to get there and engage that liquidity. So liquidity is king. Time is when we expect that to be a factor in delivery and price.
Understood. Thank you, Michael.
I think that was a good question. I like that question. Next up, we have Juan, Nico, and then Big Black Candles. Juan?
Hi, Kit. Hi, Michael.
We're
How you
doing
guys
doing
doing?
great,
Sorry,
buddy. How are you doing?
sorry, it just got me away from my notes. Yeah. I'm doing great, man. I have improved my quick feedback on the lesson. It's improved very significantly my execution, but it's still messy. I'm not happy with it. I mean, I want to get better at it. And there's a couple of, I've got 3 questions, but 2 of them are related to the FVG, so the fair value gap. Maybe I can start with that one first. Like, it's quick. Are there any telltale signs that we can expect an inversion of a fair value gap? And when and or how can we make sure it's successfully inverted? Because always looking at the 1 minute chart, but now I'm trying to implement this with the 5 and 15 second. So how can I make sure, and is there
Well,
any
that's
kind of
that's a
telltale
that's a
sign to that?
broad question, Juan. I mean,
I got it.
all right.
Okay. Anytime a price run
Thank you.
goes to liquidity and we pierce a level of liquidity, okay, and say, for instance, the market runs up and takes out buy side liquidity. Okay. It might be a pre-session high, relative equal high, or a single high, but your bias is bearish overall. So you think this is this elevation before they start to sell it off at a premium and seek a discount. Any fair value gap in the form of the buy side imbalance, sell side inefficiency, right before the high is taken, I always expect that to become an inversion fair value gap. Always. Now, it has to prove to me that it's going to be an inversion fair value gap by going down through it and then come back up and show me what it does with the first or 2 candles when it enters back into it. So it has to break below it, then trade up to at least half of it. If it fails to go to the half of it and just starts selling off, then I'm just going to take the first institutional order flow entry drill, a gap that will stay open. I know that has nothing to do with the inversion fair value gap aspect questions you said, but I'm just telling you you asked for pointers. I'm giving them to you. If it sells off, right, if it sells off and it creates a lower low, or you suspect it's made its low of the day, it's been one-sided, it's now 10:45 a.m., it's likely to have some kind of a retracement. If it's got a SIBI right before the lowest low, I'm always expecting that to become an inversion fair value gap that's bullish. Always. Okay. So if you, there'll be other, I don't want to give too much before I release the text form of it. But don't buy the book. I don't need your money. But let
Got
me
it.
put it in text form, and then I'll teach it also on the YouTube channel. So that way, people that don't want to spend the money or are listening to me, they'll get the information also. I just don't want to do it now because so many people are writing books and they're trying to get ahead of me and put their stuff out on Amazon because they publish real quick. I'm not giving them book material. But in and of itself, what I just said is just champion level inversion fair value gap theory. It's just easy. It's one trick pony. This is what you always, those are the things I'm doing.
Absolutely understood that answer.
You're
Thank
very
you very
welcome.
much. So the other question was about the lookbacks. Do we anchor them at the beginning of a month? Like, for example, we know that there's like 20 days in 1 month. Do we anchor them at the beginning of the month, or do we anchor them at the beginning of a week?
It's not calendar.
How
It's
do
not
we?
calendar. It's actually 20 trading days, not weekends, trading days.
Right. I've got that. But what I'm saying is within the 20 trading days of the month. That's what I
Okay,
meant to say.
within the 20 trading
Do
days.
we anchor them at the beginning of the month?
I'm not understanding what you're asking.
Sorry. Oh, okay. So sure. To explain it better, we're in the beginning of February. Do I use the 20? Do I anchor my 20 day look back at the beginning of January to the end of January, for
No.
example?
Okay, it's just today. Okay, today, count day one. Go back 20 trading days. Whatever that month it ends up in, it doesn't matter. You're looking back the last 20 trading days. That's your look back period.
Absolutely got you. Okay,
You're very
thank you very
welcome.
much. Kit, love you, man. Thank you very much. Michael, please keep doing what you're doing. You're
Thank
changing
you.
lives. Love you. Thank you very much. God bless.
Awesome.
Hey,
Thank you.
Kit, real
Yes,
quick,
sir.
if you guys could be invited to check your E-mini S&P chart and that same level we talked about on that wick at 5-minute 10-10 candlestick. It came right back down and touched that same level that we were talking about earlier, that 0.625 on the wick. It's the actual low, the most recent swing high, and it's now ran up over 22 handles, 23 handles on ES. It's probably random. It's probably in Wyckoff.
I definitely noticed that. Yeah, that's kind of wild.
It's all random.
Nico, you're up next, buddy.
Hi, Michael. Hi, Kit. Well, thank you very much for the opportunity to get on here. I have a couple of questions. So the first one's regarding, I know somebody asked this before, but high resistance conditions and like consolidations. So I've had the issue of sometimes like I'll miss a trade, and obviously this is more psychological than anything. Is there a way to, and then I'll like try to look for a trade and enter it, and then I get stuck in a consolidation. Is there a way I can like see something in price action that like anticipates that? And also with like high resistance, I know Michael said something about the economic calendar, using that to anticipate it. Is there something besides that, like in price action, that I could see as a rule set to say, okay, I'm about to kind of anticipate that there might be consolidation in this move, and then I can go from there? I don't know if
How many times have you been in a trade and you exited or aborted it because it no longer felt like it was viable? How many times have you actively done that?
like
Not scared out of a trade, but you're in a trade and if this isn't moving for you and you're like, okay, I'm going to kill the trade. If it gives me some confirmation at a later time, I'll consider re-entering. But right now, it's not moving. I'm not at a loss. I'm not making any money. It's just meandering around. I want to just kill it and be done with it. How many times have you actively done that?
in terms of exiting, I think I just mainly use my stop loss to do that. I don't really I don't
Okay.
think I've ever like pressed and said I don't want to be here. I don't know.
Most of my new students have the same questions as you're presenting to me here, and I ask them that question. Okay, and what it does is it gives me a barometer on how much they're willing to abandon an idea because they want the outcome to be in their favor. So the easiest way to determine if you are going to be victimized with high resistance liquidity run conditions, if you're in a candlestick on the 1 minute chart. And this is beneficial by having reflections on the lower time frames. So having a 1 minute chart, it gives you this information immediate. How many candles back is the candle you're in right now? How many candles back is it sharing the occupation of the previous highs and lows of the last 3 or 4 or 5 candles? If it's sharing the same kind of space, not the exact high and the exact lows, but it's not really moving. It looks like a UPC symbol on something that you purchase at the store. It's barcoding. If it's doing that, that's high resistance liquidity. So what would be wrong with you saying, okay, in my experience, I don't want to weather this. I feel uncomfortable with it. It's not low resistance liquidity, so I shouldn't be comfortable. It's actually telling you, prepare for slow traffic jam. Now, you can sit there and waste mental capital, which is extremely expensive, or you can say, you know what? I paid the toll, but I ain't going to stay on this. I'm going to take the first exit ramp off, and I'm going to go a different route. That means wait to another opportunity. If it breaks away from sharing the same space where it's this real fuzzy looking price action, contrast that with what we saw today in the sell-off. That's nice low resistance liquidity run conditions. There's gaps, there's fair value gaps, there's inefficiencies, lots of movement, clean lanes of traffic where it's just wide open in front of you. You ain't got to worry about traffic jams. Here, what you're describing is what can I look for in price action? If you are in a big block of price and it just simply is not wanting to leave, or it goes up a little bit and then comes right back into it, you're in high resistance liquidity. So bail on that. Just leave it. Don't be afraid to go back in with another fair value gap once it moves. You're not a breakout trader by doing that. You're waiting for displacement. But if you get stopped out when you do it again by re-entering, just leave that session. Not the day, leave the session and come back at another time and see if it's better in terms of its delivery and price. That's the only answer I have for you. That's the only thing you're going to see in my book. There's no extra stuff. It's just a matter of identifying it in price action. If price looks real fuzzy and there isn't a lot of gaps and inefficiencies and balances and such in the price runs, you are in high resistance. High resistance is going to be very daunting. It's going to be it's stressful because you want it to move. And then you find yourself trying to impose your will. You get emotional. And you start talking to your chart. Come on, man. This is bull crap. Why aren't you moving? I should have took this trade. As soon as you start doing that, bail. Because what you're doing is you're feeding yourself toxicity. And now you're spending mental capital that you're going to carry over into the next 6 trades. Even if you make money, it's going to weigh on you because you're going to be thinking, is it going to go back into that? Or I should have got out of that trade when I was feeling it. Because you're going to be worrying about stuff that you can't change. Does that help?
Yeah, absolutely. That was awesome. It's definitely helpful. So what you're saying, if I understood, is if I enter a trade and I see price, like the candles inside of the 1 minute overlapping previous ranges of the candles that are forming, then I'm probably gonna have to know that it's going into high resistance, and then see if I want to just cut my losses or like anticipate it and just exit out.
In
Right?
concert with the economic counter, because as I was mentioning, the
Yeah,
economic
with the
counter
pound.
will highlight when it could potentially be a problem. Like when do you think high resistance liquidity run conditions would be if there was an FOMC event just a few hours before the event, right? So why would
Yes.
anybody want to be in there? So you can predict the likelihood of it occurring, but it may not be there. Now take the extreme away from it, not FOMC day. Say it's a manufacturing data report that's going to be coming out. Well, that's a mover, but it's not interest rate. It's not CPI. It's not PPI. It's something that's going to be an injection of volatility, and it may cause high resistance ahead of it. Just wait for the report to come out and then see if the market gets loose. If it starts leaving porous runs and runs higher or lower, then you've entered low resistance, and then find the inefficiencies of the liquidity and trade there, and you'll be on the right path that way. But it's visually represented by the candlesticks that you're trading right now or watching real time. If they're sharing the same space that the previous candles have been, and you're just barcoding in a range and it's choppy. If it looks choppy, you're probably in high resistance. Don't be afraid to kill the trade. Don't be afraid of it. Just kill it and then wait for something cleaner. When it does give it to you, enter back and you'll be in there when it starts running.
All right, awesome. Thank you very much. And one more question. This is regarding ranges. I know you use the opening range. You'll split it into quadrants with the fib, and then obviously how you, I don't know if you just use that for targets and in terms of the standard deviations, or you also use it as like a PD array per se, like the quadrants reacting off of that. If that is the case, can you use that with other ranges as like other opening ranges for like the PM session or London session or any other like time stamp? Like you can use ranges based on time. Is that a thing?
When you say, can you use that also in what is that also? What is the
So
subtext?
like the way you divide the opening range into quadrants,
Hmm.
and then use that, like I don't know if you only apply that for standard deviations or you also apply that as to like see price go into it and repel away. Is that something you can also apply to other like time ranges, like the PM opening range or
Sure. That's how
London?
I taught it. Yeah, that's how I actually introduced it. Taught it, and you can actually use it over top of actual dealing ranges, not implied dealing ranges, actual price runs, and then it'll help ferret out where the imbalance is or the order block. Okay, the PD arrays that overlap with these gradient levels, that's the one I'm using. That's the one that you're looking for. So if there's a question of whether or not an order block should be referred to, if it's not laying on top of a gradient level, I'm not interested in it.
Okay. And like if it's, let's say, a macro range, can you use it for a macro range as well? Or no?
Well, macro is a time element, so
Okay.
I don't know how I would be incorporating a price-based measurement of range for the macro, which is time. It's
Okay.
two different functions.
I see. All right. I just wanted to clarify. Well, thank you very much. And thank you, Michael, for everything you do. You're awesome.
You're welcome. Thank you for your
Thank you,
question.
guys. Thank you.
Excellent. We're doing good. We've moved through everyone we've said. We still have Big Black Candles is up next. And thank you for patiently waiting, Big Black Candles. Jump on in here.
My dog's Kit, what's going on?
Not much, buddy.
What's going on, Coach? Hey, let me tell y'all something. So, it's 38 degrees in New York today. And so, we all happy and things like that. We've been freezing dick and balls for the last 2 weeks. But, hey, Kit, listen. So, we got a Rottweiler. We named him Dwayne Johnson, right? The Rock. So, we took the Rott outside. And that joker looked back at us. He whimpered. He was like, like, yo, bro, you got to talk to Quran about that. We
He's
don't
like, my
control
hair's
the
not long
temperatures,
enough.
bro. But the question that I have for Coach today, I'm an IPTA fanatic, ADR fanatic, OTE fanatic. Well, I'm a student. I'm not a fan, but I am a fanatic nonetheless. What I'm trying to propose to coaches, when I see, I'd asked you a couple weeks ago about taking the ideology of ADR and applying that to the weekly and quarterly range. And as I have done so, I have found that when the daily range, the daily projected ADR is anywhere near close, and I mean like within 20 to 30 handles of what the weekly projected range is, we have these large range days. And so I suppose what I'm asking, I might be trying to stick my hand in the cookie jar and get spanked real quick, but I need to know if you have anything that would corroborate that, if you would be willing to share it with me. And the second part of my question, when you came into the space, Coach, you put a post down there that said, "I am in attendance." And in the comments of that post, I posted a 30-minute chart of MNQ, and so that picture will of the MNQ chart. It will show you exactly what I'm talking about. When you have to the left of the chart, you have the highest order of business, the higher close, but on the right of the chart, you have a lower close, but that is making the wick high. Now, you've given us examples on what to do with it and when and where, why it forms, but you didn't really, give us the sauce on it. And so I'm asking if you could give a little bit more information on that, what I don't know if I've termed it correctly because I call it structural imbalance. That's the only thing my mind could come up with. Um, but I would love to know that. So it's a two-part question. One, do you have any info? Whereas the average weekly range is, basically the same thing as the average daily range, and we get these large rain days. And the second question about the structural imbalance picture that we put in the under your comment in the purple pill there.
To answer your question, in all honesty, I don't do anything like what you're saying. When I was younger, I tried to use average daily range concepts to weekly charts and monthly charts and yearly charts, and I tried to do those things. And I got quickly frustrated because what I anticipated would be useful for projected targets, it wouldn't deliver it. So it kind of fell out of favor for me pursuing that. I'm not saying that someone smarter can't find something that's useful. In my own approach to trying to do it when I was a younger man, I wasn't seeing it as any kind of benefit. And I couldn't find anything that was useful for me. If you have found something that's holding up and it's consistent, it'd be something I'd be interested in looking at. But I don't have anything like that personally, no. And I don't know where your post is, because as you're talking, I'm trying to find it and I don't see it.
Yeah. So if you look in the purple pill, when you commented, "I'm in attendance," you have 26 comments. I don't know why people are commenting that you posted you're in attendance, but nonetheless, when you posted that you were in attendance, you'll see for the question in today's trader roundup, you'll see a 30-minute NQ chart, the blue and black candles, of course, and
Okay,
then
I
you'll see
got you.
that structural
I see it.
imbalance. Yeah, so I've titled that structural imbalance. And you've talked about this a couple of times before, but I don't recall in my notes because I've got years of notebooks of notes, and I couldn't find anything where you actually told us what to call it. And you can see, considering this week's price action up until now, how that little thing that I'm titling structural imbalance, how pertinent it was. But I would appreciate it if you could just touch on that. What do we call that? What are we supposed to do with that type of structure right there?
I think you are tapping into a lecture where I talked about SMT divergence, where I use the bodies. Even though the wicks go higher, the bodies are actually lower on the higher price run that does the raid on liquidity. So I
Yes,
wouldn't
sir.
have it anchored the way you have it there. I would have it anchored with the two almost like twin bodied candlesticks that's just immediate to the right of where it says imbalance, the letter E. Right to the right of that, those two candlestick bodies, that's what I would have anchored. So that would be like
Okay.
it's a pseudo SMT. Okay, SMT is in the classic form is higher high than the previous high, but then a failure in a correlated market asset. If you were looking at, say, and this is NQ, so if we were looking at like ES, and ES went higher with its bodies, in addition, because it goes without saying, if the wicks are above it, the bodies have to do it also. But I will take a perspective using SMT theory where even though the wicks agree with ES making a higher high, NQ making a higher high, Dow could even make a higher high. But if the bodies on that higher high are lower than the previous high, that's actually an SMT divergence. It's actually showing you real institutional distribution. It's not accumulation of new longs. It's actually being sold off and thrown to the public. Like, here, you eat it, you keep the bag, and we're running away. So I think that's what you're doing here, because I don't know anything else in my repertoire that would be remotely close to what you're illustrating here in the chart.
Yes, sir. Yeah, I appreciate that, Coach. It's been on my mind for some time, and I with all of the stuff going on, it didn't come to mind to ask you about it until I saw it on the 30-minute chart again last night.
Yeah,
But
I think
that
if I'm
makes
not mistaken, I just call it.
1,000% sense.
Yeah, I think I just call it like a pseudo SMT. There's a lot of things I don't have names for still today, that are not really technically PD arrays. They're just like little quirky things that I see in price action. I don't have a name for it. I don't have a place for it. It's just an experience thing. But I think when I mentioned this whole thing about SMT, the topic was that I said, look, you can actually see SMT not just in the wicks. You can ignore real distribution or accumulation in deference to higher highs and lower lows by the wicks, but not paying attention to the bodies will many times diverge. Even though the wicks go higher, the bodies will be lower. And that's actually one of the strongest implications of heavy distribution or heavy accumulation.
Coach, I appreciate everything that you've ever taught. I want to let you know I'm one of the direct to source students. Like, I'm proud that I didn't learn from a student of a student of a student, and no, shade to any of y'all that did. If you learned from Kyle or Dodgy or any of those people, but I take pride in knowing that I sat through all of those long-winded lectures so I could get it directly from the source. Thank you.
He's just called you long-winded in a very respectful way.
Well, Kit, that's where I get it from, because when I get to talking,
I appreciate it. I appreciate it. I mean, it's just funny, different people, and just the being here. It's cool. We also are at 12:47, and we want to stay mindful and respectful of Michael's time. And as a community,
how about you, Kit?
What's that?
You got a question? I never really asked you. I feel kind of.
I mean, my questions for you. I mean, I really like. I mean, I'm going to be very, very staying focused on macros, the price delivery of macros. I mean, I'm really looking at the predictability of price. I'm also really, really focused on, like, from what you've taught from high time delivery. I mean, as much as being a day trader, I really am kind of liking the idea of some convergence and some swing points within the chart, and looking for and anticipating these higher highs and lower lows. So, I mean, if you ask me, okay, I got a question for you because we are talking microstructure. When we are talking just pure market structure, protected highs and protected lows, I think that conversation, where and how we're looking at, a calendar, where and how we're looking at, again, economic events, where we're looking at specific weeks, as you've taught, weekly profiles, kind of that expands into almost monthly profiles, which I also do believe are fractally relevant. But yeah, if I had a question, it would be within the name of the community of really looking at what I believe is a very, very valuable thing, and that is protected highs, protected lows, and where could a trader who has studied your content really looked at maybe some of those market structure insights that you've provided in the past?
Well, it sounds like you're talking about that Zircon model, because that's what I was doing. I was shorting just below what anybody else would look for a continuation and run through that old high. I was selling, building in positions right as it was creating just a slightly lower high. And I'll give you some crumbs, because it's something I want to hold on to the end of the year. Okay. But it's not a model that everyone's going to agree with, because it's going to take a lot of experience, and it's conviction. You gotta know what you're doing, or you're going to see lots of losses. But when it presents itself, it's when, well, we just came off the heels of the pseudo SMT. If there's things that warrant a reversal, or a market has ran its course, it's done a nice run, there's no other reasonable expectation for it to go any higher. It's exhausted any previous range projections that would make any real sense, but it has an old high and it came off of that high. If the market rallies up, and say you get an SMT divergence where it's a correlated pair, if it's 4X, or if it's ES versus NQ. I'm not going to do this with YM. Dow can do a lot of squirrely things in and of itself, because it's only 30 stocks. 2 stocks heavily pushed in that will make that whole index go crazy. 1 stock could do it, really. So it can create false signals, false sense of security, false pretenses in price action. So it's not enough to validate or support an idea. but ES is 500 issues versus 100 issues with the NASDAQ. The weighting of it being tech in NASDAQ supersedes the disparity between 500 versus 100. So they are, in my opinion, close correlations. If ES fails to make a higher high, or if the bodies, like we just mentioned here, the bodies are failing to make a higher high than the previous high, you already have a stage for zircon. So what you're doing is you're looking for a turtle soup to go above a recent high, okay, a recent high, but not take out the highest high in proximity. So if you don't know what I'm talking about, just go look at my little post. It's a video I have on my YouTube channel. It's the zircon. Zircon is actually it's a missile, a really powerful missile. That's what I named it after. So it's kind of like always some kind of arsenal or some kind of something formidable. Okay, that was the way I've named all this stuff. You know, action guy, right? So it's running an old high, but leaving a high that everybody would use as a shorting opportunity with classic support and resistance. Anyone that uses the stuff I've been teaching that would expect that run out for a break above and tap out their long position and selling their longs to buy side, they're not going to get in. They're not going to get their fill. And it's just one of those perfect elements where it isn't going to go higher. There's so many things against it. There's so many supporting factors that I'm not going to go into detail here, but I will at the end of the year. It's a wonderful model when it presents itself. It looks too perfect. It's too pristine. Well, if you just look at the example, you can't get much better than that one. And it's a wonderful opportunity to be in control of your decision making, not be fearful. Oh, it's going to run that high, or it's going to stop me out. You know what they're doing. They're leaving bait for support and resistance traders, breakout traders, and even in my group of or school of thought where we run out highs and we sell our longs to that, or old lows and we expect that low to be taken out and we sell to that, or we buy it back rather. There are times when the market is poised to negate every one of those things and just stay in a realm where it looks like it could do it, but it ain't going to do it. That's a reversal pattern. That is the most complex, difficult methodology for reversals that I have. And when it's there, though, the entries are putting you in at the high. A couple ticks off the high, but you're in there at the high because you can see that they're getting as close as they can. And you probably have experienced this before. You've been in a trade. You're expecting the market maker sell model to come to the relative equal lows or the old consolidation. And it's selling off. And you're like, okay, we're only a couple handles away, 20, 30 handles away. And you're like, this is going to be a matter of time now. It's just going to dump down there and get it. And all of a sudden, it just says, nah, I'm not interested. And goes the other way. And then what happens? It becomes an enormous buy. It completely blasts through smart reversal and keeps on going higher. That's zircon. So there's conditions, there's characteristics that are there that I'll show you I look for that. So what it does is it defends me. I'm not always just going in there and just looking to short at high that isn't going to be taken out or buy a low that isn't going to be taken out. I'm not stating that that's the primary function. It's actually an insurance policy for me to protect myself from expecting my market maker sell model or buy model when it doesn't come to fruition. A lot of times I'm taking profits. And if you go back and look at my executions, you'll see that I'm padding out partials. Because I got the questions all the time when I was teaching the market maker models. They were like, well, if you know this is what's going to happen, why are you taking partials there? Why aren't you just letting it go down to full target? And then it would be trolling and whatnot. It's because there are some times that in my frailty as a human, or when the market in itself takes upon its own accord to go out there and just screw what I want to do in the marketplace because, it's a manipulated market. If there's enough liquidity in there to say, nah, we're going to reverse it here and run it the other direction, or geopolitical event takes place, anything can happen. But I'm always trying to take some kind of a partial on a market maker sell model and a buy model because it could present a zircon and I didn't pick up on it because of manipulation that comes in the marketplace. If they do something in the Middle East, they do something over here or there, something happens in the States, causes some kind of a reverberation, anything can happen. So to protect myself, I built in this procedure of I don't need that original consolidation to be profitable. That old low doesn't have to be taken out. So if it goes there and goes through it, wonderful. I have limit orders down there to get me out. But I'm taking something out in the event that that low is guarded, or if that high is guarded, it's not going to be allowed to be breached. So I ended up creating a model that has repeating characteristics that became something that I could actually trade. And I would go in, I'd say, okay, well, I know it's not going to do this because it's all these things listed as precursors that this is why it shouldn't do it. Even though it looks technically sound that it's going to trade up there, every school of thought says it's going to go there. Supply and demand, Elliott wave, Wyckoff, you name it. There's all kinds of reasons why that high should be engaged. But if all these factors are there, and there's a list of things that I'll share in the fall months of this year, if they're in opposition with one another, they're diametrically opposed, that high or that low is not getting taken out. And it'll be a rip going the other direction. I know that probably didn't satisfy you, but it's a nice cliffhanger.
No, I love it. I love it. I mean, that's awesome. That's awesome. Yeah, man.
Did you learn anything today? Did you learn anything?
Yes. I mean, the RTH gap,
The ES wick?
yeah, the 10-10 or what was, yeah, it was, was it 10-10? Was that the time? Wait, yeah, it was 10-10.
5 minute candle.
Yeah, the 10-10 candle. I mean, I know, and you do 100. I love grading and 25% and quarters are cool. I also personally like classic Fibonacci, right? Like there's the old school, 23-6, 38-2, 61-8. I love seeing the Fibonacci kind of spiral and seeing that within price, mate. I love that. And it's just crazy how accurate all of your stuff is in quarters, in Fibonacci, and whatever you want to call it,
Isn't it fascinating when you really get down to the nitty gritty and you want to get really detailed and you put away this notion of it's complication. No, it's a deep study of something that if it's really rigged, if it's really controlled, you would see evidences that when you place price under strict scrutiny, critical theory and analysis, what is happening at this given time? What's happening at that given candlestick? If there's a wick, why is that wick doing that? Why is that wick only moving this far below its open, or this far below its close, or above its close, or above its open, in deference to a premium wick or a difference of the discount wick? What makes the wick that length? Why is it doing it? It's not random. It's not random at all. And if it's going to present that wick, and if it is controlled, if there is an algorithm, if it's 100% scripted, that wick is going to be implementing something in the future because everything has its place. Everything has its place. So when we see a wick, if there's a candlestick there, ignore it, go to the wick. The wick takes precedence because it's going to be the greater gap. Because what is the wick doing? It's proving a rejection at an interval in time, whatever time frame you're looking at it when it forms. That wick is showing you that it's traversed down when it's a discount wick. It trades down to its lowest form, makes the low of the candle, and then goes back up and closes. So now you have a wick below the body of the candle. That range is not random. It's never random. It's always going to be implemented in the future. But if it's an extended, long, lengthy candlestick and it's sharing the same range with the newest candle to the right of it, ignore that candle to the right. Treat that wick as if it is a real fair value gap. And if it's doing that wick at a low that forms just a little bit lower than that, in other words, it creates a pivot and starts to rotate higher, swing low, that wick will act as an inversion fair value gap. And out of one of my students asking about whether or not I would use a mitigation block, going into what he was asking or what you were prompting me to look at, my eye went right to that wick because that's the hierarchy of it. The wick is going to take precedence over every other PD array because it's manipulation of a range that is not artificial. It's designed to be there. It's put there. So when we see these wicks that form around news, That's not entirely random because they're just trying to get overzealous about it. Because why is it that you can go back and look at PPI numbers and CPI numbers and it'll go right to a volume imbalance and stop? It'll go right to consequent encroachment of an opening range gap. It'll go right to the lower quarter quadrant of a new day opening gap or a new week opening gap. It's not going random places. It's going to a very specific price point. So when we look at wicks, wherever there are wicks inside of consolidations are gold mines. They're absolutely gold mines because as long as you know where you're likely to be going to, directional wise, that wick will tell you if it's bullish, it's going to support price in the upper half of that wick. If it can't even touch the upper half, or consequent encroachment rather, if it can't even touch that and starts to rally, what is that indicating? Strength. So is it going to run for a premium inefficiency above market price, or it's going to run for a short-term high for liquidity? If there is neither, it will run up, create a short-term high, sell off, and then go back for, and there's the liquidity engineered. And look at your ES chart, and you'll see that very thing happening here.
A masterclass on Wix today, ladies and gentlemen. In addition to the YouTube channel content today, where the trading looked pretty easy. So Michael, you made it look very easy, and I think a lot of folks were kind of tripped out by that. So yeah, I think it was a really, really good day. It's 1:03. I know there's a lot of folks that are still here. I know you have your hands up. We're trying to do this in concentrated doses. Michael will be back. We'll be back. Again, we're really trying to set a tone and a precedence and what's okay and not okay. And hopefully everyone can just embrace the classroom that we are. Okay. So, I mean, Michael, thank you. Thank you for your time. Thank you for your energy. It was great. And
thanks for all the questions.
Yeah, I thought they were good. And folks, as you have questions, add them into the comments. And then Michael, I'd also suggest, you look in the comments here as well, because you'll see some folks saying some stuff. So anyway, much love, everybody. We'll see you again soon. This is the ICT follow through, the ICT mentorship follow through with Michael, your boy Kit here, FX for Living. Thank you, David, for co-hosting with me. Thank you, each and every one of you, for coming up and asking a question and adding value to the conversation, to the classroom that is of price, that who and what we are as a collective. So again, thank you, Michael. Thank you, David, and we'll see everybody next time around.
Thank you, Kit. Thank you, Michael. Thank you, everybody.
Be safe.